Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 266th VideoCast podcast for the week ending November 21st, 2024. A lot of great stuff to cover today, but as always, family first. So this is a picture of Caitlin with Annabelle and Mimi at the Sabrina Carpenter concert in Orange County this weekend. So they were excited to do that. That's Mimi and Annabelle. Annabelle is also now at 6'8 Academy playing water polo in addition to swimming. So they're doing that together. More Sabrina concerts. And in case you were wondering, with the family being over there and me being back and forth, I did buy a house in Orange County in the last couple of weeks. We're doing some awesome renovations that are going to be done early December. So I'll be spending probably 20 days a week, 20 days a month in Orange County, California, 10 days a month at our place in New York City, and we'll rent out our couple houses in Connecticut and see what we want to do after they get into college or the Olympics or whichever one comes first. So that's the story. So very excited about that. And these are the photos from, by the way, these are the photos from in front of Fox when I went in to do Fox yesterday, Varney and Co. That is Fox and Friends. That's right in the front of the building. That's the Christmas tree that they put up during holiday season. Absolutely incredible holiday spirit. There's the green room. For those of you who are new listeners, haven't got a chance to see, this is the green room for not only Varney, but Charles Payne and for Gutfeld, that big Studio D in the back. And you can see it here in the background, all the cameras and the cranes and all that stuff that goes into it. So absolutely incredible. Today is very interesting. Just as I'm starting to record this at 1:17 p.m. Eastern time, what are the headlines? Well, the headlines are Dow jumps 500 points as investors rotate out of tech stocks linked and into stocks linked to the broader economy. So tomorrow's newspaper today is what Hedge Fund Tips with Tom Hayes is all about. As you can see, Google down, Amazon down, Nvidia down today, everything else green, which is moving the right direction. We'll talk about some of the seasonality around these things and how we're thinking about it. First, want to thank Christian Dagger and the great Stu Varney for having me on Fox Business yesterday to talk about Nvidia before earnings and small caps. So we're going to listen in here.
All in the green. Thomas Hayes joins us again this morning. He's covering the market for us today. Let's start with Nvidia. Their report after the bell. What are you expecting?
Well, Nvidia is priced for perfection at around 40 times earnings and around 40 times sales. So let's hope that their earnings come in as hot as their Blackwell chips, which are melting the data centers.
Has that been refuted?
Well, the information had data. The company is telling them to realign the chips in the data centers so they don't create so much heat. While it is priced for perfection, there's a good chance that they pull it off this quarter. The key is going to be the guidance moving forward. Oh. But implied volatility is 8.5%.
What do you mean? What's implied volatility?
It means the amount that the stock is expected to move on earnings. So that's going to be a $300 billion swing either up or down on a $3.6 trillion stock.
And what do you think is going to happen? You got an opinion on this?
Look, we don't own the stock. I think it's priced for perfection. You know, there was a time when you owned Nvidia and the multiple went down as the stock price went up because the profit margins kept going up. The profit margins are no longer going up. So maybe they eke out a couple more quarters of stock growth. But I think at the end of the day, as the multiple continues to expand and the profit margins stay where they are, and year on year on the quarterly revenues only growing $4 billion, which is amazing. But 40 times sales, it's not in our wheelhouse.
So buying today would be a risk indeed. Okay, yeah. Don't answer the question. Okay. You've been hot on small caps.
That's right.
I want you to tell me what is the best small cap ETF for our viewers out there, many of whom are interested in this sector of the market.
Yeah, I think the easiest way to play small caps as a basket, which worked very well in Trump 1.0 after the election and into 2017, is IWM. That's the Russell 2000 ETF. easy to get broad-based exposure. We like to own some individual companies, but I think that's an easy basket for people to get involved.
Got it. Then that's the iShares Russell 2000 Index, IWM. Okay. Tom, thanks for being with us this morning. We appreciate it. Thank you very much.
And we're back. And then on Friday, I had the pleasure to join David Lin on the David Lin Report. And these are just phenomenal interviews. He's got such a large, engaged audience. I invariably get two to four phone calls every time I do his podcast. And we really go into detail the perceptions of the Trump administration versus the reality of the Trump administration, and where to look in the pockets of opportunity moving forward. This is a great one. We're going to listen in now. We are going to see nominal GDP run at levels that we have not seen in decades. I think as you look 2 years out, I could see 4, 5, 6 handles like we haven't seen in ages. Do not be surprised after this initial short-term weakness or spike in yields that we get a bid in treasuries following the inauguration, and that lasts for some time. So these are some things that people are not expecting. And like we say in the business, the first move is often the wrong move.
Thomas Hayes, managing member of Great Hill Capital, returns to the show. We'll be breaking down his analysis of the economy, the markets, and what's happening with the markets into the new year. Welcome back to the show, Thomas. Congratulations on yet another good call. You've been right on the rally, and it looks like the rally is sustained up until now. A bit of a pullback today on Friday. 1.29% drop on the S&P 500 as of noon Eastern time. The Nasdaq's down 2%. So this week's looking like a losing week, Thomas. We'll talk about that. Welcome back.
Thank you. Thanks for having me, David. Great to be here.
So losing week. It feels like, of course, we're short-term focused. This has only been a couple days since Trump won, but it looks like the Trump euphoria has been fading this week. Was it just a short-term fade, short-term trade? What happened here?
Yeah, I think the initial reaction was a lot of people were offsides into the election and had to chase up. And then this is a consolidation of the gains that we saw. If you look at seasonality since 1932, if you look at the roadmap, this is pretty normal into about the third week after that initial pop off the election, that relief rally, that kind of certainty, the uncertainty clearing type of rally. You do get some weakness into late October around the third and a half week, and then you tend to persist with strength, year-end rally into the inauguration. Now, we got something for everyone here. For those people who don't love Trump, the first 6 months after the inauguration and after an election, it tends to be sideways to a grind down. For those who love Trump, you get that rally into the inauguration, 6 months of sideways, and then the second half of the year tends to be a very strong rally in that first year of a presidential cycle. But the good news or bad news, depending how you look at it, is that's the average since 1932, whether you have a Democrat or a Republican in power. So I think what's going to be new here, David, is what is perceived to work under the new Trump administration and what has actually worked under the previous Trump administration, if you want to go into some of that.
Well, is there anything he's proposing that's dramatically new in its respect to how it may impact the markets?
Well, people think the 60% tariffs with China is new. This is what he ran on in 2016. And interestingly enough, the minute after he was elected in 2016, what you saw, there was some weakness of emerging markets and Chinese stocks into the election. I don't know that was predicting a Trump win in 2016. Very few people were, but that weakness persisted into the inauguration. So the months of November and the months of December in 2016, emerging markets were weak, China was weak, China tech was weak. And then following the inauguration, we had one of the biggest rallies in the shortest amount of time in history in emerging markets, in China tech, in Chinese equities, despite him running on protectionist tariffs and being the tariff king. So I think the surprise for 2025 will be that these stocks start to do exceptionally well after the election, despite the consensus that they will remain weak, and they're weak into the inauguration on the basis that tariffs are coming. the other thing that's happening, David, that we're seeing right now that we saw in 2016 as well, is the US dollar rallied like crazy on the election into the inauguration and then completely rolled over the following 6 months. You had a weakening like you hadn't seen in a long time from January 2017 through the summer of 2017. And then the final one that's going to be the shocker is everyone thinks yields are going to blow out because Trump is going to deficit spend and he's going to lower taxes. And the exact same thing happened in 2016. He was elected in November. Yields blew out until the inauguration. And then you saw a big reversal. Bonds started to get bid. Yields compressed the entire first year of the presidency. And basically the 10-year yield during that time, this set of circumstances will be slightly different, was between 1.29 and 3.2, if you can imagine, during his presidency. But certainly this time the range will be higher. But do not be surprised after this initial short-term weakness or spike in yields that we get a bid in treasuries following the inauguration, and that lasts for some time. So these are some things that people are not expecting. And like we say in the business, the first move is often the wrong move.
Before we continue with the video, let me tell you about a growing threat and risk to your personal safety that you should be aware of. Over the last decade, politically motivated online threats have surged, especially around recent election cycles. With the conclusion of the 2024 presidential election, concerns around personal information exposure remain critical. Today, 3 in 4 voters fear political violence fueled by how easily personal information like phone numbers, home addresses, etc. can still be found online. That's where today's sponsor, Delete Me, comes in. Delete Me removes your personal information from hundreds of data broker websites, helping you stay safer online. Using Delete Me is simple. Submit your personal information for removal, and within 7 days, you'll receive a privacy report showing where your data was found and removed. Delete Me continues to monitor and remove your information throughout the year, keeping you protected long-term. For 20% off all U.S. consumer plans, go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout, or scan the QR code on the screen to get started. Link also down below. Take control of your online privacy with Delete Me today. The first move is often the wrong move. Well, let's break down these asset classes that we've talked about. So starting with the last one, yields. So you're right. Let me just pull up my screen here. We can take a look at exactly what happened in 2017. This is the chart of the U.S. 10-year yield. Trump's last inauguration, January 2017, was here. Yields had a blowout, like you said, went down, and then went back up. Now, I wonder how much of this decline from 18 to 20, basically 2018 to 20, was a result of the tariffs. People just offloading on U.S. dollar and offloading on treasury assets. Here we go, 2018, 20. This is the U.S. dollar here. So similar decline. They followed each other, U.S. dollar, the 10-year yield. Was this a result of an escalation of tariffs with China, or was this a result of just the bond market reacting to other forces here?
Yeah, I mean, it can always be a combination, but the key thing is he ran. There was not a surprise here in that he ran on tariffs, and the market was expecting tariffs. So the market is a discounting mechanism and tends to act much before it actually happens. So he had been talking about it since 2016. And I think you got me looking at here, January 2017, and this is
March 18th.
Yes. Yeah, so that's exactly what we're talking about here. You saw a spike in the dollar and then weakness in the dollar following the inauguration. And I think if you look at commercial positioning right now, David, I think I was on your show in October of 2023 when everyone was selling bonds in the hole, yields were out, and I was saying, buy bonds, buy bonds, buy bonds. And we had a rip your face off rally that lasted for over a year.
Okay, so given your outlook on the Fed funds rate, what's your outlook for the short term and long term of the yield curve?
Well, I think the biggest surprise for the second half of this year, and where all of my focus is on, is that there is going to be an unexpected rally in the 10-year bond. If you look at the commitments of traders, which is an important measure that we look at very carefully, it works differently for different instruments. But when it comes to 10-year bonds, you can look and see that the commercials have been aggressively getting long for the last couple of months. They always are early and they always are right. I think in the back half of the year, what no one's expecting is that the 10-year is going to get bid, and that's going to have a huge impact on this rotation moving forward. The two key themes for the second half of this year, in our view, are US dollar continues to be soft and weaken. And number two is the 10-year bond gets bid, which compresses yields, which has a positive impact in terms of mortgages, in terms of banks, in terms of REITs, and in terms of the rotation into small caps, which the largest sector, of course, 21%, is financials and small banks. Right now, commercial positioning is at an even more extreme level than that, i.e., large traders and hedge funds are the most short that they've been since 2018, I think it was, before we had a rally. The last time that you had hedge funds and large traders this short, let me know when you pull up bonds. You got the dollar up.
So you're looking at 2018. Yeah, that's yields
the dollar.
Started falling in October 2018. Yeah.
Yeah. So you have an exact same situation right now. Commercials are aggressively long treasuries, meaning they expect yields to come in. Hedge funds and large traders are shorting in the hole. So this is consistent with what we saw in 2016 after the election and before the inauguration. Yields blew out and then they came back in. Same thing. Dollar straight up and then weakened after the inauguration. So I think the theme is, regardless of the noise in the short term, bonds will get bid in 2025. Dollar will weaken and resume its weakening trend again in 2025. And that's going to be helpful for emerging markets and ex-US, despite the current sentiment, which is US exceptionalism, everything in the US with the Trump trade. It just simply didn't bear out that way from 2017 through 2020, albeit the economy did exceptionally well in the US, but not at the expense. It wasn't an either or, it was a both and.
So there was a massive move back in the last Trump presidency. From November 2018, the 10-year went from 3.26 all the way down to about 0.5. Yeah. But about like almost a 300 basis point drop over the course of 2 years.
Yeah, and no one would have predicted that whatsoever, and that's what we're talking about. I'll tell you another shock. If you can pull up XES, which is oil servicers. Okay, so everyone thinks drill baby drill. Yeah. These are going to be the greatest trade of all time, and so you had that huge spike into the inauguration after the election, and then it was the greatest short of all time. If you had shorted energy, oil and gas servicers from the inauguration over the next 2 years, you made a fortune under the Trump administration. Was down 90%. Yeah. So even if you pull...
What was the WTI doing during the same period? I'm curious. Okay, so this oil didn't actually underperform to the same extent, except that big, the COVID was a one-off, right? This went from like basically whatever it was to zero, but okay.
Pull up XLE, pull up the integrateds. You would think that they would be less hurt, not after the inauguration.
What happened to the miners or the oil companies?
Yeah, basically, you had more supply, you had more subdued prices than you had historically had, which hurt margins, which helped the country, which helped inflation be lower. Helped business, helped real incomes, but didn't help the energy companies because they work on margin, and their cost of production was higher than it is today, and the price of oil was also a lot lower. So that's not a formula to generate a lot of cash. The other one that was a big shock is look at XRT retail. Also spiked on the expectation of a strong consumer after the election, and then as you got to the inauguration, right there in January 2017, you had weakness for the next year.
Mm-hmm. Yeah, that's what happened. So 2016, 2017, inauguration was January 2017, and then basically went down 12% into the trough. Well, okay, so a couple of things may be different this time. So we're in a
Yeah.
rate cutting cycle.
Yeah.
Uh, During the first couple of months of Trump's presidency, that did not happen. The Fed was not cutting rates in early 2017, I believe. Well, let's just double check that. So here's the effective Fed funds rate, 2018. Yeah, actually, they were in a tightening cycle the other way
Yep.
around. So that's one major difference. The other major difference is I'll let you evaluate this, but people have been calling for a recession. It may just be a moot point. Maybe it never happens. We'll see. I'll let you respond to that. And then the third thing is taxes. It's been speculated he might be even more aggressive with tax cuts this time around. So three things: monetary policy. The second thing is whether or not we're getting a recession. There was no recession in 2017, 2018. And then number three, taxes. How do these forces impact the general markets?
Okay. So monetary policy, pull up XLU and XLV. XLU first, which is interest rate sensitive, it's utilities.
Yeah.
Everyone would think this would be a train wreck under Trump. And what did you see? You saw weakness after the election, and then after the inauguration, complete rally for the next year.
Yeah.
Okay. So this is consistent with bonds getting bid, dollar weakening, all of that stuff after the inauguration. So as it relates to monetary policy, that will be supportive for yields lower. It will be supportive for dollar weaker. However, I do think the terminal rate, and we've said this a bit on your show, we believe this was a mid-cycle adjustment. We think there's many more years in this bull market, and therefore the terminal rate is probably going to be a lot higher than most people had anticipated. Most people were looking for 3%. We've been kind of the lone voice saying it's probably going to be more like 4%, because if you look back to 95, which was a mid-cycle correction, and some other mid-cycle corrections in the late 60s, they didn't have to go more than about 150 basis points to get to an acceptable non-restrictive stance. And I think that's going to be the case this time as well. XLV is healthcare, same thing. Everyone's selling it off today on the basis of RFK Jr. taking over, and some expectation that no one's ever going to take medicine or a vaccine again.
Yeah, I didn't see that. It's a 10% drop in the last 2 days.
Yeah. So if you go back to 2016, you'll see it did the same thing after the election and before the inauguration. Weakness and then strength for the next year. You got to go further up. There you go. Yeah, November.
Yeah.
November, straight down into the inauguration of January 2017. No, yeah, now you're there.
Okay.
Yeah, now to January 2017, and then after the inauguration, straight up.
Right.
So again, all of these things, you know what else did the same thing? Believe it or not, ARK, ARKK, the thing that is absolutely blown up. She could rise like a phoenix from the ashes here in this environment as bonds get bid, yields go down. So she had weakness after the election and then straight up for the next year plus. So you said monetary policy, you said cutting the taxes. This is an enormous deal. This is the white swan that people aren't putting enough emphasis on. With the sweep, which was only confirmed basically 24, 48 hours ago, even though it was pointing in the direction, if you take the tax rate from 21% down to 15%, your tax expense is reduced by about 29%, which would imply in the short term, earnings estimates are too low at 275, and they should be rated over $300 per share on the basis of just that tax benefit. Then if you apply the multiplier effect of the reinvested capital over the next couple of years, you start to look towards 325, 350, and no one has that in their numbers right now. So I think that people are underestimating earnings power, earnings growth, earnings broadening under the Trump administration, and that now that you have a sweep, the 15% corporate tax rate is almost a foregone conclusion. And that's going to have a material impact. That would never in a million years pass if the Democrats held on to the House. So that is an rated white swan event as it relates to earnings, and makes the market, which seems like it's pricey right now, start to look a lot more reasonable if you add back the re-rating of earnings.
Okay, so the last couple of jobs reports were pretty positive. We're working with the assumption that this data is pointing towards a soft landing. I think a lot of people, even on my show, have kind of given up the recession narrative. Where do you stand? I bring that up because, as I said earlier, in 2017, Trump wasn't facing a recession prospect.
Yeah. So I think we've covered this on your show in 2023. And basically, everyone was waiting for the recession. And I got on your show and I said, no, this October 2023, this is a buy opportunity because the recession that everyone's waiting for already happened. And if you look back to Q1 and Q2 2023, you had 2 quarters of negative GDP growth. That is a technical recession. The government never acknowledged that it was a recession, but that is the definition of a technical recession. So the recession that everyone's waiting for has already happened. And usually you get a recession once every 4.5 years. The problem is we had one in 2020, and then we had a second one in 2022, first 2 quarters of 2022, excuse me. First 2 quarters of negative GDP growth. And so you basically had 8.2 years of recessions in 2-year period, which is why you could go a handful of years without another recession. It was just pulled forward. And I think that's what people are missing now. So soft landing, no hard landing. How about no landing? How about we just hit an earnings trough in Q3 of 2024, and we're going to start re-accelerating earnings growth led by the unmagnificent 493 over the Magnificent 7. Magnificent 7 earnings growth has decelerated from the first quarter of 2024 at 50% earnings growth to now in the mid-teens earnings growth. That's going to continue to stay in the mid to low teens. Unmagnificent 493 has had negative earnings growth in Q1 and Q2, just inflected positive, and will start to re-accelerate into the low teens earnings growth in 2025. So that broadening is going to be a general sense of well-being, growth, and excitement in the economy, not just a handful of companies driving the bus.
Okay, you brought up ARK, so let me just bring up tech stocks since ARK is kind of tech heavy still. So this is the NASDAQ composite, January 2017 to its peak in October 18, up 48%. I'm curious what the Russell did during that same time period here. 2017 January, all the way up to the peak, 25%. So the Russell actually underperformed the NASDAQ during the same period. Okay, your view on tech stocks overall? Because I know you brought up ARK. Tesla shot up to the moon in recent weeks. Mainly because of Elon Musk's association with the administration now. But this is what happened with Tesla. It went up about 40% in a matter of a week. I don't know if that had to do with the fundamentals of tech stocks or more to do with politics, but I'll let you address this.
Yeah, I think this is going to be a surprise for a lot of people, whether you look at ARK or FFTY, which is the IBD 50 Momo stocks during that period, or XLK, or even SMH for semiconductors. They all did exceptionally well under Trump. So small caps also did well, but they pulled forward a lot of the gains in those 2 months right after the election. If you look at it, it was that huge rally off the November lows, and then it consolidated for that 6 months before resuming higher. So I think that's the surprise, and that's what I'm trying to emphasize. People think, oh, it's only an energy and industrials game and banks game, but actually energy was a short of a lifetime in the Trump administration after the inauguration, and tech did well. ARK did well, semis did well, equal weighted, small caps did well. China, you know what else did much better under Trump than under Biden? Pull up TAN, solar stocks. Okay, this is not my neck of the woods, but if we're just being objective, take a look at what happened from 2017 to 2020.
Wow, and then 90%, yeah.
Yeah, and then if you look at the Biden administration from 2021 through 2024, no bueno. And this is another misconception people will have going into the Trump administration, thinking they know what's going to work under Trump. And it's, for the most part, the exact opposite of what they're expecting. Now, industrials did well, staples did well, discretionary did well, financials did well. Most things did well. The two things that stand out that didn't do well, which is surprising, is energy and retail stocks. XRT, you can pull that up. And biotech did well. By the way, biotech did well. So healthcare
I was going to
did well.
say it looked like a lot of defensive sectors did well, but it wasn't just defensive. I mean, some of these things you're pointing out to aren't defensive at all. But yeah, okay, up 20%. I think the wild card I wanted to address with you is we talked about tariffs, but the escalation of trade wars in general and more protectionism, would it force China and some other competing nations to I would say buy less of American goods, tech, right? China has, in the last 4-year cycles, they've greatly advanced their own tech sector. They don't need the argument is they don't need Apple or American chips anymore. They can just make their own.
Yeah, look, I think the conversation is going to go something like this. Mr. Xi Jinping, you're taxing us massively on everything that we put into your country. We're going to just match it. So we're going to start at 60%. We can go, if you want to tit for tat and go up to 100%, we'll go up to 100% too. If you want to go down to 30%, we'll go down to 30%. Oh, and by the way, Mr. Xi Jinping, if you want to have zero, we'll do zero as well. How does that sound? And that's basically how the conversation is going to go. So my guess is Xi Jinping is initially not going to want to negotiate, so Trump will just match him where he is, which will look like 60%. If you look at all the objective data out there, what it shows is if in fact Trump initiated a 60% tariff on all Chinese goods, it would hurt Chinese GDP by 2 full percentage points. So it would move from 5% down to 3%, which is still in line or slightly better than the US is doing right now. So bad news for China, but not devastating news for China. Because when I first heard 60%, like everyone else, I thought, wow, that would put them in a Great Depression. They would be down, their GDP would be negative 5%. It would be, a train wreck. It's simply not the case. They become more consumption driven, more internally driven. So I think the beauty of the Trump administration and why Chinese stocks did so well after the Trump inauguration in 2016 to 2018 is because Trump is not an ideologue. It's not we have to start a Cold War with China just because their economy is growing. It's let's get a deal done that benefits Americans. Americans first. We want to create jobs in America, but we got to do a deal. And it's not about creating the next Cold War. It's about just getting more money for Americans. And I think that's a different framework than the previous administration had, which was China's bad, period. No need to talk. They're our enemy. They're our threat. And I think Trump just wants to do business.
I just want to talk about retail one more time since you brought up XRT. So January 2017, in the months following the last inauguration of Trump, the XRT went down about 14% to its trough before climbing back. It didn't seem like the tax cuts worked in terms of stimulating consumer demand. Is that right?
Well, if you remember, the tax cuts took a while to pass.
Okay.
So there was a long process to get that through. And I think it was towards the end of the year that they finally got that done. So I don't think that has an immediate direct implication. And don't forget, that wouldn't kick in and put more money in the taxpayer's pocket until the following year when they filed and got their returns and all of that. Now, it might change expectations. It might change sentiment. It might change all of that. But the point that I'm trying to drive home is how people are thinking about the Trump administration is completely different than what actually happened in Trump 1. And the policies and the outlook and the appointments are really no different. It's the same red hat. They added one number to the side of it, and same policies, effectively the same proxies. And I think you'll see the same result, which is that it's an environment where Wall Street certainly does well, but for the first time in decades, Main Street was absolutely humming. If you remember from 2016 to 2019, the average middle-class person was feeling so much better. Small business owners, real incomes were going up. And it's that type of excitement, I think, that you're going to see start to be felt next year and for the next 3-4 years, where everyone's participating versus just the people at the top.
What's the NFIB latest small business optimism index showing right now? Do you know?
The sentiment indicators that I've looked at are just starting to turn up for the first time in the last handful of weeks or months. So I think that trend is going to persist under Trump. Even if you look at institutional managers, while they've become more enthusiastic, they're not quite at euphoric periods. If you look at the Bank of America Fund Manager Survey, they look like managers usually look coming out of deep troughs, but not yet at peak excitement, peak sentiment, peak positioning. And I think the same is true for the consumer confidence, which has been really low because of the price of groceries and different things that affect their everyday lives, is just now starting to turn in the right direction as incomes are slowly starting to catch up, and now on optimism on a renewed set of different policies.
I want to bring up one more step before we go, Thomas. Just going to get your reaction to this. This is an op-ed written by former FDIC Chair Sheila Bair. I actually had the pleasure of speaking with her this week. Anyway, this was an op-ed she wrote. CFA Institute recently surveyed over 4,000 of its members on the state of U.S. finances. Supermajority, 77%, believe the U.S. finances were on an unsustainable trajectory. A significant majority, 61%, believe that the U.S. lacks the political will to reduce its debt to GDP ratio, while 63% believed we will begin to lose our reserve currency status within the next 5 to 15 years. First of all, are you in this camp at all? And does this sentiment have any effect, long-term and or short-term effect on the bond market?
Yeah, two things. Number one, they misspelled her last name on the article. I think they have it as Bair. It should be Bear. I've watched her interviews for the last 10 years,
Okay.
and she's consistently bearish. So I'll leave that. Number two, you've got Elon and Vivek coming in that are doing something that hasn't been done for decades, if ever, which is they think they can cut $2 trillion of costs. Let's say they're wrong and they can only do $1 trillion of costs.
Yeah.
That's deflationary. There's going to be a lot of people unemployed out of government jobs as they cut down different agencies, and they cut a lot of those jobs until they get absorbed into the private sector. Then you're also going to have an issue with labor, different supply of labor than we've had in the last 4 years as the border gets closed up, and maybe some people are returned back, but certainly as the border gets closed up. So I think that I think we're going to see a situation where the terminal rate is higher than anticipated at 4%. And I think inflation is going to be higher than anticipated. They'll keep talking about 2% to pin inflation expectations, but they know it, you know it, I know it, everyone knows it. They've got to run inflation hotter in order to bring the debt to GDP ratio back down from 120 to a more reasonable level like we did after World War II. From 1948 to 1956, we took it from 120 down to 53. And in those years, inflation ran between 3 to 5% pretty consistently. And you had hot nominal GDP growth, which is exactly what we're going to see under the Trump administration. We are going to see nominal GDP run at levels that we have not seen in decades. I think as you look 2 years out, I could see 4, 5, 6 handles like we haven't seen in ages. And that will do a lot to bring the ratio down based on these policies.
That's nominal GDP. What about real GDP? What about inflation adjusted? Is inflation going to catch up, you think?
I think inflation is going to be higher than 2%. I think it's going to be,
wow.
I think the mean is going to be 3.3, 3.5, somewhere in that for the next 5 years. And if we do that, then debt to GDP comes down and all the Sheila Bair articles will be solved. It's reasonable to have that fear. I mean, if you look at the numbers objectively today, people should be worried. I think that the country is worried enough that the voting electorate looked like a pizza, not blue raspberry Jello. I mean, when you looked at the map, the country went red and it swept, and it's why? Because they believed that in the short term, that election could get these things in order. Now we get to see if they were right. And if, in fact, we can get our fiscal house in order. But it certainly seems like if anyone could get it done, Elon and Vivek would be the people you'd want to tap.
Okay, so that aside, let's assume you're right. So government becomes more efficient. We'll come back to that at another time. Let's see how that plays out. But let's just address inflation before we go. So you brought up inflation going north of 2%. So this is what happened during the last Trump presidency, hovering above 2% for most of the term. There were periods when the CPI, headline CPI, was down below 2%. But I'm pointing this out because it didn't spike considerably due to Trump's protectionist policies. I'm hearing a lot of this in the media, the fear that inflation is going to go way back up because of tariffs. That didn't really happen last time.
Well, the key thing there,
now.
what's the key input cost to everything is energy.
Yeah, you're right. Energy was deflationary for some parts of the last Trump presidency.
Yeah. Yeah, and it was coming off much higher levels too. From 2011 to 2014, energy was really high in terms of price, and it was more normalized under Trump because supply increased. And he was blocked on some of the things to get supply going. If you recall, with the pipelines, with the Anwar, with the opening up the different government things, he's not going to have those type of restrictions, certainly in the first 2 years of his presidency. So there is a lot that he can get done that will be deflationary and very, very positive and very productive for the country. So all in, it's a good economic formula. I just think that if history is any prologue, from 1932 till today, continued strength after this short-term November weakness until like after Thanksgiving, into the inauguration, stock should be up. And then that 6 months, it will have to consolidate while the market figures out policy, the appointments, and everything else before resuming some strength the second half of the first year of the election cycle.
All right. Well, you heard it here first from Thomas Hayes, the Trump trade that may or may not be. So where else can we follow your work, Thomas? By the way, you can check out our last interview with Thomas, link down below. And visit some of his calls from a couple months ago. But where else can we follow you?
We have a blog, hedgefundtips.com. That's where we post all of our weekly podcast. Is called Hedge Fund Tips with Tom Hayes. It's ranked number 1 or number 2 in the hedge fund category. You can find us at YouTube. Just put in Hedge Fund Tips. X.com. You can find us at symbol Hedge Fund Tips. And TikTok is a big thing for us, at official Hedge Fund Tips. That's been phenomenal for us. So that's the easiest. And to contact us, just do so at the website, hedgefundtips.com.
Okay. We haven't talked about TikTok, banning TikTok. We'll see if that happens. But anyway.
Yeah, it's not going to happen now under Trump because it doesn't want Zuckerberg to have a monopoly. So you will be able to do your crazy dance music there, David.
And we'll be able to follow. And we'll be able to follow Hedge Fund Tips on TikTok without fear of getting
official Hedge Fund Tips. That's right.
Yeah, all right. Yeah. Thanks very much, Thomas. We'll speak again soon. Take care.
Thanks, David. Appreciate it.
Thank you for watching. Don't forget to like and subscribe.
And we're back. And then let's get down to some of the quotes of the week here as we kick in. David Tepper, who, by the way, one of the greatest of all time, in my view, and empirically, by the way, that helps too. His number 1 position is now Alibaba. And what David Tepper says is, we keep our cool when others don't. The point is, markets adapt, people adapt. Don't listen to all the crap out there. So he's not known for his eloquence, but he gets the point across, and that's how Jersey boys do it. Warren Buffett, in the world of business, the people who are most successful are those doing what they love. And Seth Klarman, it turns out that value investing is something in your blood. There are people who just don't have the patience and discipline to do it, and there are people who do. So it leads me to think it's genetic. The older I get, the more I realize it's 100% genetic. Certainly, you got to learn the core skills, but there's some things that can never be taught, and you find that out quickly. Our brand portfolio is the best in the industry, says Stanley Black & Decker CEO Donald Allen Jr. So excited about this one, by the way. They've been putting in a base for a year and a half, and they're going to get rocking as rates go lower over time. But he was on with Kramer this week for a phenomenal interview where he laid out the plan to $2.5 billion of EBITDA by 2027, basically 2 years away. Just to put that in perspective, I think the stock is it's probably up a little today, but call it an $85, $90 stock. Been bouncing around between 80 and 100 for, a year and a half. And the last time that the business did they never did 2.5 billion, but the last time they did anything close, 2.3 billion of EBITDA was in 2021, and the stock price traded to $200 a share. So well more than a double from here. He's not talking about 2.3, he's talking about 2.5 billion. And the plan hasn't changed since we got involved. We're super excited. So listen in here.
Today, Stanley Black & Decker, the iconic power tool maker, held an investor event here at the New York Stock Exchange, where they laid out some exciting long-term targets for the business. Okay, it's been a difficult stock to own, I know, over the past couple of months, something we know because we own it for the Chapel Trust. Stanley Black & Decker roared into the Fed's first rate cut because historically when the Fed cuts short rates, wow, long rates come down, mortgages get cheaper, people spend more on anything housing-related. This time, the bond market didn't play ball, and long rates are actually up from when the Fed first moved. Plus, when Stanley Black & Decker reported its most recent quarter, management did talk about headwinds, understood, persisting into 2025, and of course, we're worried about the impact of potential trade war and tariffs. So in less than 2 months, the stock went from 110 to 85 and change. I still think it works over the long term, as I certainly wouldn't own the stock. But let's check in with Don Allen. He's the president and CEO of Stanley Black & Decker. Get a better sense of where the company's headed. Mr. Allen, welcome back to Mad Money.
Great to be here, Jim.
All right, so Don, you had a big meeting, and you talked about a lot of very exciting long-term goals. And I think it's pretty across the board that you want to make things, let's say, bigger and better. So why don't you give us a sense of some of the things you talked about? Because over the long term, I think things are going to go very well here.
Yeah, so we spent about 3 hours with our key investors and a variety of other analysts that were either in person or on virtually. And we focused on really making sure that folks understood how we were going to finish the supply chain transformation, but more importantly, what we were going to do to drive more value at Stanley Black & Decker and get our EBITDA initially up to $2.5 billion by 2027. And then we see opportunity to go beyond that after 2027. And it's really going to be driven by, we think will be, probably a modest growth story in the short term, but over time, gaining more market share in DeWalt, gaining market share in Stanley branded products and Craftsman, and then driving more opportunities in the supply chain around product platforming, better strategic sourcing, et cetera, et cetera. So we were really excited about telling that story today that allowed us to really get people to focus on a longer period of time versus just the next 12 months.
Okay, well, let's talk about the brands. I really want to focus on tools and outdoor for a moment. It's DeWalt, Craftsman, Stanley, Black & Decker, Cub Cadet, which I know personally. These are unbelievable brands. And a lot of times we think, and I know I am definitely of this opinion, these brands are bigger than the company's stock price, so to speak. They're remarkable brands that everybody knows. And could you explain to people, how important they are? I mean, on the Lowe's call, they talked about DeWalt being one of their biggest products, and that somehow things get lost in translation. We start talking about tariffs, we talk about rates, we don't talk about the brands, which are the best in the industry. How do we jive the two, so to speak?
The portfolio of brands that we've created, Jim, is the best in the industry. So we start with our DeWalt brand, which is the pro brand for the construction industry. It is the best professional construction brand out there today. And then we have the Stanley brand, which is for trades and professional construction and occasionally the do-it-yourselfer, which is more oriented around hand tools versus DeWalt's more power tool oriented. And then Craftsman is kind of the do-it-yourself enthusiast, the person that works in their garage, works around their lawn. And these three brands fit incredibly well together in a strategy. And there's nobody in our industry that has the power of these three brands. And when you look at these other brands here, like Lennox, Irwin, Black & Decker, and Cub Cadet, they're what we call specialty brands that allow us to be targeted in certain niches, certain markets. They're not as broad as the three big brands, but they're very unique and they're very specialized and they differentiate themselves as well.
It is hard to outrun the story of how rates didn't come down, housing, it's the worst housing market for turnover in 30 years. And we also don't understand exactly what is going to happen with tariffs. You can't necessarily go blow things out if those things aren't working in your favor.
That's exactly right. And I think we all agree that long term, this is a great industry.
Yes.
Interest rates will eventually come down to a level where mortgages are closer to 5%, which I think is an important hurdle for us to get to, which will free up more repair and remodel. It'll free up more home sales, new home construction and housing starts. That will really allow this industry to get back in a much stronger place than it has been.
All right, now let's talk about one that's strong and one that's not. You've got some incredible things going in fasteners, in aero, but you also have auto.
Yeah.
And auto's slow. You can't give away. I mean, at one point I just said, oh, why doesn't Don just get rid of the auto? But you don't want to sell that at a trough.
No.
And aero is just terrific, but I kind of feel like the great nature of it gets lost in the shuffle of the brands. I don't know.
Yeah, the auto fastener business is very much a V business. So when it goes down hard.
Right.
When it recovers, which actually, interesting enough, I think what's going to make this business recover is lower interest rates, because it's affecting, car purchases as well. So as that changes, then I think you're going to start to see a V recovery where the business goes up fast. And if you look at the previous recessions for that business, that's exactly what they experienced.
All right, so tell me, as a shareholder, and I've told many people in the club, this is the best stock for the long term. What do you say for people right now who are saying, you know what, I don't know. I mean, I didn't hear anything that says that next year is going to be a breakout year, 2027 maybe, but it's worth holding. I mean, what do we say?
Well, I think one of the things that we tried to get across to people today is that there's the power of the cash flow of this company that we've kind of really brought back to the last 2 years. I'm going to continue to do that next year and beyond, which allows us to get our leverage where we want it to be and eventually buy back our stock. So that's an important part of the strategy that we'll be focused on. The other thing is that, there's going to be some short-term things like tariffs to navigate.
$200 million headwind.
Which is a big headwind. But you know what? We think we have a plan that we can execute on. We've already started to talk to some of our customers about price increases. I've spent a lot of time in D.C. talking to the new administration and really making sure that we have a voice at the table around the tariff process. I completely understand what President Trump's trying to do with tariffs, but I wonder if it's really something that shouldn't be broad-based, but more specific to certain industries where Chinese products are more challenging coming into the U.S. market. That's not necessarily our case.
Right.
And where power tools and hand tools and those types of things, 50% of what we sell in the U.S., we make in the U.S. And 25% of what we what we sell in the U.S., we make in Mexico, and the remaining portion comes from China and Asia.
Well, it's much different from the way it used to be.
Yeah,
The
totally
reshoring has been important, and you've been working on this for a long time.
Yeah.
To me, I think that all of these things are momentary, and we have to think longer term.
Yeah.
And that's why we're going to stick with the stock.
Excellent.
Thank you so much to Don Allen, President and CEO of Stanley Black & Decker. You know their brands. You've all used them. You know how good they are. Ed Money's back in.
And we're back. Now we're going to go on to some of the data here. Disney shot the lights out. Absolutely phenomenal earnings, which we covered last week. China's economy stabilizes after stimulus, and we saw that in earnings, which we're going to talk about in depth. Look at China's retail sales results. By the way, I got my Baltusrol shirt on thanks to my buddy Mike Bennett. Absolutely love it. So here's retail sales from China. Then we've got retail fund inflows have driven money assets to record. Money market have driven money fund assets to record. So there's still a tremendous amount of cash on the sideline that's getting forced in, and you're seeing it in spades on days like this. And by the way, it's so interesting. Obviously, Cooper Standard's having a good day, but the little sleeper that no one that could. I remember getting all of the Ask Me Anything questions coming in on Comstock Resources when it dropped down to 8 and change, and everyone's like, "Are you sure you still like this?" I was like, "Yeah, the intrinsic value is only $40+ a share. I really don't care about the thing moving a buck." And now it's up to 16 and just getting started. 1565. I mean, things up 50% in a handful of weeks. So, okay, international e-commerce revenue is growing while core segments stagnate. So this is kind of an analyst analysis here. we're gonna drill down. First and foremost, Taobao and Tmall revenues were up, and when in looking at Pinduoduo, the parent to Temu, which I said for many months, the numbers are either unsustainable or unreliable. They absolutely crapped the bed this morning. And why? Because of fierce competition. From whom? From Taobao and Tmall, keeping their share, fending off the threat of them selling garbage stuff at low prices. And as the consumer mends, guess where the money is going? It's going to the higher quality providers like Taobao and Tmall. And as the Chinese economy hums, they don't want to buy the cheap Chinese crap. They want to buy the high quality foreign luxury goods, luxury brands. And Taobao and Tmall is not going to grow 1%. They're going to start growing 5 and 10%. Cloud shot the lights out. We'll get into that. Absolutely incredible. Their EBITDA was up 89% year on year. Revs were up nicely as well. International continues to grow like crazy, 30% or 29%. And then these smaller businesses did just fine. So we'll get into that. Retail sales was driven by what? Motor vehicle and part dealers. This was the best component. Also electronics and appliance stores. Best component of, which reminds me, I got to go back and take a look at Whirlpool. We haven't done anything there. But so new cars and part dealers. So Advance and Cooper Standard on that. Pretty excited. Corporate profit margins near record highs. I'm a mean reversion guy. I think these can stay pretty accelerated with some of the tailwinds, with tech, with AI, with all the other stuff that's happening. So that's a positive sign. Economic Surprise Index, Citigroup, absolute positive sign. Japan going through the floor. Same thing I've been telling you guys. All the money's going to flow out of Japan. All Japan was a money market for Asian investors that didn't want to be in China. And India was ahead of itself, way ahead of itself in terms of valuations. Definitely the future of Asia, more so than China. But the next 3 to 5 years belongs to China. One last parabolic move, and then we'll take the profits from Baba and start to find opportunities in India. Japan, absolutely not. Their demographics are toast. No matter how cheap their stocks are, unless most of their revenues come from abroad, I'm completely uninterested. Plus, the yen is going to appreciate, which is going to hurt them more. Leading economic indicators and real GDP moving up in the right direction. This is all from Yardeni, these green charts. Truck tonnage picking back up. Also rail freight loads picking back up. Those are the key indicators that you want to be looking at from an economic standpoint. Here's rail car loadings turning straight up. This is the stuff you saw in 2010 and 11, not 1999, not 2007 when they were at peaks. This is turning up now at the beginning of a new mid-cycle reacceleration that we're going to have by getting the terminal rate down to 4% and probably not a lot lower. Railcar loadings. We got more of that. For motor vehicle, railcar loadings are picking back up as well. Intermodal railcar loadings. So, and then consumer sentiment is turning up, not down. And you see these things coming out of deep troughs, like in the early 90s recession, coming out of that. And for those of you looking for the recession, we just had 2 in the last 4 years, 2020 and 2022, when we had 2 consecutive quarters of negative GDP growth in Q1 and Q2. So this is what you see. You see these checkbacks and then recoveries like 2011, just like you saw in 93 and even 2001. So we are just getting started economically speaking. And I think people are seeing the pro-business, deregulatory policies, tax-friendly policies moving forward are going to be so great for the economy. And it's not just going to be the people at the top that do well no matter what the environment. You're going to see like Trump 1.0, where real incomes rise for everyone, everyday people doing real work will get the benefits of this type of economy, which is pretty exciting to see. Consumer optimism's coming off the mat, but it's moving up in the right direction, and that's going to reaccelerating. Job openings are down off of extreme once at 100-year level. So that will keep the Fed in the market continuing to ease, or at least posture towards easing, which guidance is sometimes almost as important as the action itself. Non-farm business productivity growth cycle is elevated. That's good. Manufacturing productivity starting to get back up over the zero line, like you saw after World War II, and you see coming out of all deep troughs. Used car and truck prices coming down. Number of motor vehicle light sales going up. So everyone was super depressed in October. Now you look at the October numbers and they're tracking on a 16 million SAR when everyone's been talking about 15.5. Let's see if that persists in November and December. Could be super duper exciting. And as we all know, what's the target? In 2017, got up to mid to high 17s. It depends on the data source here. Here's light motor vehicles, but got up to the high 17s. The company Cooper Standard earned $7 a share, traded 146. We're going to get there, ladies and gentlemen. The difference is we're going to earn a lot more than $7 a share, and we're super excited about that. Domestic auto inventory to sales ratio. This is what we want to see moving up off a depression like the cash for clunkers era, like the 2001 era, moving up in the right direction. Fits and starts are normal, and then you get to where you need to go. U.S. motor vehicle sales, let's see, moving up to that 16 million again. So you had that check back over the summer that everyone got nervous about. It has been sideways for a year. I think we're going to break out here and move back up towards 17, and Cooper Standard is going to mint money like you could call Cooper Standard the new Treasury Secretary. They're going to print so much money, it's going to be insane. China nominal versus real retail sales ticking up. China real retail sales growth ticking up, not down, up, despite all the headlines. Nominal GDP versus M1. Okay, so this is the name of the game. They got to get money supply going. Like this is economics 101. And guess what's happening? It bottomed a few months ago. It's turning up. The same exact thing you saw in late back in 2016 to 2017, turning up here once again. M2 is turning up in China, not down. That's a positive thing. M2 growth rate, same thing. Consumer confidence in the U.S. turning up. This is all moving in the right direction. China PMI turning up. China foreign direct investment flows turning up from negative, turning up, not down, ladies and gentlemen. And then here are the two most important charts of the week as it relates to Cooper Standard. Look at what's happening to incentives, ladies and gentlemen. It keeps climbing every month. It went to 7.7, and what's happening to prices? They're leveling off, maybe going a little bit down. That's the name of the game. We don't care about the margins that the OEMs make. They should be a race to the bottom. They had these halcyon days where they could control supply during COVID and rip people off by charging 10% above MSRP and play a bad game on the public. Well, now that game has changed. They are going to be producing themselves like it's going out of style, more cars than ever, at lower margins than ever. And Cooper Standard is going to be putting the door sealing, the window sealing, the fluid transfer systems, the fuel delivery systems in every single one. And God forbid Trump actually makes interest payments on new cars tax deductible. We may see a cycle top like we've never seen before, meaning over 18 million SAR, seasonally adjusted annual rate. And that is not in our models, but certainly quite possible, especially when you consider the average car on the road 13 years old. It could be staggering. Deal Track Credit Availability Index. You can see all the anecdotes if you follow Car Dealer on Twitter, basically saying as soon as Trump got elected, all the spigots turned back on. They are doing loans like it's going out of style. Subprime, prime, doesn't matter. If you have a heartbeat, you're getting a loan for a car. That's what we want to see for Cooper Standard. 75-year high in stocks versus U.S. stocks versus rest of the world. This is the type of concentration where you want to take the other side. You've seen it 2 times in history. Once you had the opportunity in 1967 to buy emerging markets in ex-US and dramatically outperform, and the second time was in 2001, and you absolutely rocked the world as you saw money move out of move back into emerging markets and ex-US, and we're going to see that. And that doesn't have to mean the US does poorly at all. The US is going to do fine. If I had to guess for next year, I think earnings growth will probably be 13, 14%. I think the S&P will probably be up 8 to 12%, and I think fortunes will be made under the surface in the US, and ex-US in emerging markets in China will be through the roof. So exactly the opposite of what everyone's saying right now. Just like in late 2016 to early 2017, in Trump won after the election and before the inauguration, which we covered with David. So, by the way, check out his channel at David Lin on YouTube. B of A bull and bear indicator. Again, it's enthusiastic, but it's not at a peak level yet. Trading Tina Turner. So here's from HeartNet Flow Show. Okay, what he says is, what turns the trade before the inauguration day is further tightening in financial conditions. Global macro most likely driver of higher FCI as companies front-running tariffs. October, China export growth was the fastest since July of 2022. China has massively reoriented exports to destinations. California port volumes right now are jumping. Port of Long Beach imports a record high in October. No asset allocators increasing bonds and international stocks right now, but we say allocators heading into 1Q 2025 should lean into buy treasuries. Okay, we couldn't agree more. If less, and this is the thing that's mind-boggling to me. He's got two of the most efficient people, effective people in the world in Elon Musk and Vivek Ramaswamy that say they're going to cut $2 trillion. So these guys tend to do what they say they're going to do. But let's just say they don't realize what it takes to get stuff done in government and they only cut $1 trillion. That is deflationary, ladies and gentlemen. Deflationary, not inflationary, which means bonds are going to rally next year. The biggest two surprises of 2025 will be bonds rally, yields compress, dollar weakens. No one is positioned for those, and watch what happens. And then the second thing that HeartNet says, which we again agree with, buy international stocks, China, Europe before inauguration day, China to ease fiscal policy, and ECB to cut rates aggressively in anticipation of America First tariffs. Lower rates, cheaper currencies, lower oil prices means big easing of financial conditions in Asia and Europe relative to the U.S. Bear sentiment soon to approach buy humiliation levels. Here we are, ladies and gentlemen. So excited about that. Strong China export growth to the rest of the world. So while exports to U.S., EU, and Japan have gone down, rest of the world are skyrocketing once again. And that's the name of the game. You know, all these things that we do to unnaturally change the market, i.e., cut them off of chips, et cetera. Now they're developing their own chips. Before they used to be dependent on us, and now we've made them independent, and they're going to catch up. Blocking the exports, they've just built stronger alliances with countries they wouldn't have paid attention to. So, you got to think second and third degree, not first degree on some of these policies. Certainly you want to deter dangerous threats, and there are ways to do that effectively. But I think we'll get a more pragmatic administration in with big threats and then come to a table and do great deals, and everything will be much better than it has been. Big government expenditures as percentage of GDP since 1791. Vivek and Elon are going to knock this down. We haven't seen this level since World War II, which again, we haven't seen the 120% debt to GDP since World War II. And what happened? It collapsed right after that. Same playbook, same story. We've covered it many times. Globalization to isolationism. So, for everyone that says can't do tariffs because it's going to cause a great depression like Smoot-Hawley, tariffs had been climbing off a low like this from the Spanish flu, 1918, for 12 years before Smoot-Hawley. So the idea of doing some tariffs, which, by the way, it's like, oh, we're unilaterally hurting these people. No, everything that Trump is going to do is going to say, look, you tax our goods, we're going to match you. I mean, it's very simple. And what's the corollary to that? if you don't want us to match you, just take your tariffs down. That's a simple, very easy request. Eye for an eye, tooth for a tooth, and that's exactly what's going to take place. So coming off such a low base, yeah, we're going to see tariffs go up for a number of years before it becomes any major issue. Could be 8 to 10 to 12 years out. If that persists, and if the counterparties don't cooperate by bringing it down to zero. It's a very thoughtful strategy versus, like, in fairness, Trump has said since 1980 on Oprah, they've been ripping us off for years, and we continue to take it, and we're not going to take it anymore. And that's exactly what's going to happen for the next 4 years, certainly the next 2 years. So disinflation demographics peak in 2028. This is the world dependency ratio minus the economically dependent population. So that's going to be an interesting factor. Money market fund assets to all-time highs, 6.7 trillion too. A lot of this is going to chase into markets next year, so be cognizant of that. Biggest outflow from gold since July 2022. We've been covering that for weeks. We said don't chase these guys at the top, and there you go. I'm not saying that the gold run is over. I'm just saying there are higher and better uses from these levels. There's no question about it. Record outflow from China equities past 5 weeks. That's perfect. The same exact thing happened in 2016 right after Trump was elected. And what happened after the inauguration? The biggest rally in the shortest amount of time in history. We'll cover that this week. Biggest outflow from utilities since March 2015. Remember, everyone wanted utilities 4 weeks ago. I said, guys, no. 8 weeks ago, whatever it was. Now some of them are getting very interesting again because bonds are going to get bid. 51.4% of consumers expect stocks to be higher over the next 12 months. Funds are overweight momentum. I wish this one went back further. Active fund position is still defensive. Peak growth and expectations for the Mag 7, which is interesting. Last time we were this high was right before the 2022 correction in tech. So for those of you, you could see what I was kind of jockeying with. Varney was trying to say, trying to get me to say about NVIDIA, and I'm like, we don't own it. We do not own it. Would you buy it? We don't own it. I couldn't be any clearer. So that's the story there. And on to the next. Who's left to buy the Magnificent Seven? The answer is basically no one. Most crowded trade. This cycle has been the most race sensitive in history. 5-year rolling correlation with ISM manufacturing. So as rates come down, ISMs go up. Easing rate pressure should translate to a pickup in manufacturing. This is the Trump economy, manufacturing, small caps, industrials, etc. Wall Street stock allocations typically fall as 10-year rates move above 5%. So we're below. We're going to stay below. Not to worry. We'll probably be in this range, 3 to 4% on the 10-year next year, which increases stock allocations. Retail sales were up, driven by cars. We covered that. Less cars, it wasn't up that much. ISM manufacturing, Empire State manufacturing. Empire State was through the roof this month, and ISM will catch that very, very quickly. Empire State, so that's what happens. You see every single time New York takes off, ISM follows shortly there behind, which is a big deal to get those manufacturing surveys up. Empire, we covered that. Manufacturing activity surges in New York region to the highest level in nearly 3 years. And keep in mind, manufacturing has been in a Great Depression for the last 2 years. This is a big, big, big news for the economy. Again, the people that make stuff and do stuff are going to get paid, which is really exciting. Anyway, daily shot financial index conditions moving up. S&P 500 around close elections. Well, this one wasn't that close, but the point is it goes up. Fewer cheaper sectors left. They're talking telecoms, not interested. Energy we have through Comstock. Banks we had a great trade on. We still have the KRE. we'll probably let that run for a bit more. We made a lot of money on that because it's been we bought it in the hole during that Silicon Valley debacle in 2023. What sector outlook for the next? So no one wants real estate and utilities and staples. I'm seeing some opportunities start to pop up in those areas. That's what I like. Everyone's cramming into financials after they've already doubled, and tech after, so again, same story, happens every single time. What is this? This is the cyclicality of the year. Oh, so what he's pointing to here is you get a big drawdown or not a big drawdown, but you tend to get a drawdown in late November, which we kind of just had, and then you just rip higher into the end of the year, which maybe we're seeing the inflection today, would be very, very nice. Economics, Bloomberg Economics Federal Reserve sentiment model coming off the mat. That's good to see. Deflationary grocery prices almost going below the zero bound. That is a big deal. Prices actually did fall 0.1% in October, the first annual drop since January 2020. Japan retail investors sold stocks last week. Get ready to sell more. They bought at the top. They're going to sell all the way down. China retail sales value going up. China industrial production up. Biggest outflow from utilities. Some opportunities popping up there right before rates turn and compress. National Association of Active Investment Managers, they're exposed, but it's not at an extreme yet, so we could get some nice strength into year-end. Dollar coming up against this resistance. This will be a huge surprise next year. It will roll back over. CPI, good. There we go. By the way, I had to get three cars registered in New York before shipping a few of them out to California. And I wound up going to this garage. The guy had 5 bays, and he totally helped me out because one of them I've been running on temp plates for like 6 months because I just didn't have time to go get it registered. And the car was coming the next day and closed to ship it out. And if I didn't get the inspection done, the state of New York wouldn't send me title for the vehicle. So he totally helped me out. He was jammed. And it turns out it was Charlie Gasparino's of Fox Business's cousin. They grew up together, completely small world. And John, the other brother, was saying that Charlie was the smartest guy in school growing up and a serious boxer. So many of you, if you watch Fox Business, you know Charlie Gasparino. And Ellie Terrett, who's the producer who gave me my first break on TV on the Clayman Countdown 5 years ago. She's Charlie's producers now, and she's known as the Crypto Queen because she's the top journalist in the in the entire crypto community. So keep a lookout for her if you have interested in crypto. Hopefully she'll get her own show one day. So S&P risk premium back to 2001 levels. I love everything that points back to 2001 levels because what ripped like crazy after that? Small caps and emerging markets. Small business optimism turning up. National Association of Home Builders housing market index is turning up. The data has been very mixed on this. Because of rates. Rates will come back down. Home building will go up. That's going to help also Stanley, which we just saw in the interview. Equity issuance. This is the thing. You want to own the big banks because the issuance is going to go through the roof. IPOs, M&A, all that stuff's going to be up. The question is, how much of that is already priced in? Because we had doubles on the expectation that that stuff was going to absolutely fly in 2024, and it started to pick up. But I think a lot of that news is priced in. So I'd love to see a big pullback in financials so we could get back in. We had such a big run on BAC and C and took profits. We'll see if an opportunity opens up. But we never sold the KRE with the regional banks. So, all right. Earnings sentiment turning up. We're going to take a look at that in a second. The estimates have started going back up after being flat forever. 10 U.S. stocks account for 20% of the entire global index. Haven't seen that since the early 70s. Those concentrations always get worked out. Everyone comes up with their stories of this time it's different, and yada, 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 and a new narrative sold by the bankers and pushed by the journalists. And it's never this time it's different. It's always the same. So stretched valuation, U.S. market is reflected across most standard valuation metrics. So you can see in the percentiles, EV to sales, free cash flow yield, price to book, enterprise value to EBITDA, forward PE. They're all in the 95th to 100th percentile. Free cash flow yield is the only thing that's cheap, 63% decile. So this is why we have such an emphasis on finding discrete individual companies that are trading at very reasonable valuations, just starting their turnarounds, got through the destock cycle, now in the restock cycle, which China is, still in the middle of the destock cycle, probably 6 months off from the restock cycle. And you want to be in ahead of those inflection points, because when they go, it's just straight up. Forward PE, obviously a lot lower on the S&P 600 than the regular indices. That's where you find your opportunity in the U.S. Profit margins at record levels, we covered. Containers coming through LA near all-time high. PE ratios, and you can see by sector, small caps down here at 16, mid caps, large caps at 21, mid caps also down here around 16. So that's price is what you pay, value is what you're going to get. That's where you're going to find the big value. Mid caps like VF Corp, like Generac, like Stanley Black & Decker, like a lot of the names that we've covered, small caps, Cooper Standard, Comstock Resources, etc. See these estimates turning back up for next year, earnings estimates. Record inflow to large cap equity funds. So everyone was buying Mag 7 at the exact wrong time last week. And there we go. Weekly bankruptcy filings, everyone's saying they're ticking up. They couldn't be lower. Yeah, they're ticking off like a dead level. Tiny. Nothing to even look at here. Same thing you saw in 2011. Little spike ups after the collapse. They've absolutely rolled over. Here's Morgan Stanley. This is also a little worrisome because Michael Wilson, who was the biggest bearish guy in the hole in October 2022, remember the triple break putt, for those of you guys who were with me, now he's raising his price target to 6,500, and that's predicated on the Mag 7, which is the exact wrong way to think about things, is being index bound versus stock bound, where the opportunities are going to be. But at least he finally got a little religion, and it'll probably be a little bit right for the next 12 months. Russian leader Putin signs a new doctrine that lowers the threshold for using nuclear weapons. That was, not ideal, but Trump will step in on that front and hopefully come to some positive resolution in a reasonable amount of time once he takes office on January 20th. U.S. homebuilder sentiment reaches 7-month high after election. Here's the tariff scenario. This is a stair step over time. This is Bloomberg's estimates for China and the rest of the world. So they're not anticipating any rise in tariffs through the end of next summer. And then it'll be a small stair step from 12% to 20%, and then another year and a half, and then it goes up to 25%. My guess is it will probably be one set. They'll meet us in the middle, and it'll be elevated from where it is now, but not anywhere near the headlines are advertising. European stocks have underperformed U.S. in 8 of the last 10 years. I would be looking for discrete opportunities there. BMO sets next year's S&P 500 target to 6,700, 14% gain from here. Buybacks by corporate clients have accelerated in 2024 like you've never seen before. That is pretty significant. U.S. dollar total percent returns. December is the worst month of the year for the U.S. dollar, so keep an eye on that. That should be interesting to watch. Data centers could ignite a surge in power demand. That's why Generac's been doing so well. Equity indices trailing 12, well, that's part of the reason. 12-month earnings, the other is hurricanes. 12-month earnings per share. Hyperscaler, this is an interesting chart. Hyperscaler CapEx growth is expected to decelerate. When they move from training the large language models to inference, the demand for chips is going to go down exponentially. And you can see that CapEx is going to start to move down, according to that Goldman Sachs article. We forecast a 25% increase in completed U.S. M&A. And the other thing to keep in mind is there will be new entrants, and the dependency on TSMC for NVIDIA is only as good as TSMC until Intel comes online with their foundries, which the government will make sure happens, and then Intel will be minting money like it's going out of style. We forecast a 25% increase in completed M&A transactions in 2025. That's going to help regional banks. It's also going to regional banks because there's going to be a lot of consolidation in that group, which is going to help small caps. It's also going to help the people facilitating the deals, which should be the big banks. And the question is, how much of that's priced? Probably not all of it, but enough of it at this point where I'd want to be a buyer at much lower levels. Gap between Magnificent 7 and 493 earnings growth is expected to narrow. By the way, I think last week I said we were hopeful to do a 30-minute call this week. Good luck with that. We've got too much to cover, ladies and gentlemen. Too much stuff, exciting stuff is happening. So here's what you see. Mag 7, Unmagnificent 493 by 2025. The game changes and you start to see them both in double digits, and by 2026 they basically converge. Small business optimism turning up. We covered Goldman out with the art of the deal note. Bullish. The other thing to keep in mind here is the seasonality of NVIDIA. While it's the weakest month of the year for the US dollar, it's also the weakest month of the year for NVIDIA stock. So keep that on your radar. Emerging stocks struggle versus the US. You have not had an opportunity like this to buy emerging market stocks like since 2001. And you know what happened next. We've covered it many times. But just a reminder, most people are very excited to buy things up here and up here. And, you know, it's not just emerging markets. It's some of the other things that we just talked about a second ago. And this is what they wind up with. And no one wants to buy them down here. And this is what they wind up with. But the reason no one wants to buy it down here is because they can't live with, or down here, it's because they can't live with this for a couple years in order to get their, in this case was a 5-bagger. They can't live with the 3 years of uncertainty and up and down. You know, someone put on Twitter about Bob, this is brutal. What's brutal? I mean, like, seriously, the stock is $85 or $87. Like, I mean, if you've been listening for a while, pretty much everyone that is on this call probably has a basis in the low 80s to mid 80s. And some of you even in the 70s and 60s, you were buying in the hole like crazy when it got down to $58. Who cares if it spiked up? We knew they were going to rip out the idiots who bought at 117, take them down below 100. It took them well down below 100. And now we get rid of those idiots, and then we'll finally have our final move up, and we'll talk about that later. This is from Ryan Dietrich. Here's that seasonality in November. You know, we got that rally off the election, then grinding, and then we got some weakness. Everyone got scared out with the Russian thing and blah, blah, blah. And now we're probably in that trough period here about before Thanksgiving and going to reaccelerate into year end. This is from VF Corp. Thanks to my buddy over there at Stifel. Basically, they put a buy signal with a $27 target, and they're looking at $2 a share with no growth. They say, what if you do get growth? It's going to be a lot more. So their initial upside target is $27. This is so exciting. I remember being on TV. I think it was with Liz Clayman. The stock was $15. And, you know, it's very tough for people to believe when a stock is down that much that it could ever do anything good. But you got to bet on the jockey. Bracken Darrell, same thing. He came into Logitech when the stock was down 82%. Within 8 years, he had a 26-bagger. So that means if you put $1 million in Logitech when he took over the reins, 8 years later, you had $26 million. So I'm not saying that's going to be the same case, but you're betting on a winner, and he's got great brands there. You got Timberland and North Face, which are going to be through the roof as China recovers. You got Vans, which he's stabilized. Now the new schoolers are selling out. He's got great stuff coming out. You got Dickies, which is a quality work brand that will recover, and he can still sell the PAX business to generate some more cash to pay down debt. Their interest expenses come down with the sale of Supreme. He's doing everything he said he was going to do, just like Shane O'Kelly with Advanced Auto Parts, just like the guy we just heard from Stanley Black & Decker. I love these type of businesses. This is like, for me, I sleep at night because once I get solvency risk off the table, then it's just a matter of time for the recovery. I mean, in the case of VF Corp, been around since 1890. They've been doing this stuff, buying and selling brands forever. God, what was the other one I think Stanley's been around almost 100 years as well. There was another one that blew my mind that was over 100 years old. Okay, consumer composite indexes, again, turning up. U.S. homes under construction. So this has dropped off. This we need to start to see, and we're going to see. I know there's going to be a solution in the Trump administration. Building permits will go back up and bring the cost of housing down. Yes, I probably bought the top in Orange County, but that had nothing to do with an economic decision. That had to do with a family decision. But I did get it. I still got a good deal, and the reason I got a good deal is because, and I got to have good deals. It's just in my DNA. So the seller had these tenants in that their lease, because it's a huge, anyway, he had a bunch of people living in there, and but their lease didn't end till May, so he couldn't list the house because no one wanted to buy it with tenants in it. So I offered him 0.75x. He took it, and then I met the tenants. I said, "How much to get out by next week?" Gave them $100,000, and they were gone. So there you go. It worked out, and it's walking distance to the beach, so that's not a bad thing either. So that's that. First-time buyers share of U.S. housing prices, U.S. housing purchases. So again, we got to bring that affordability down. That happens in rates. That happens in supply. And there will be positive developments. I think the biggest thing that's going to happen is somehow the Trump administration will force or incentivize local municipalities to open up zoning dramatically. And if they can do that, and they can create land supply, and they can bring rates down and affordability down, even if they're building 1,500 square foot houses instead of 4,500 square foot houses, I think that's going to get the thing absolutely cranking. So that's that. And then buy side positioning in small caps starting to turn up, which is good. Slow rate cut cycle is actually a blessing in disguise. So everyone's like, oh, I hope they go in December. No, you kind of hope they don't, because in the instances where the cutting cycle goes more slowly, the stock market tends to do much better. Here's Slumer from RBC. Let's get down to that. So we got to look here. S&P moving up, drop back here. Now it's starting to work back higher again. That's good news. Equal weight, same story. NASDAQ kind of stalling out here, deciding if it's going to break to new highs or not. I wouldn't be surprised if it does, certainly after the inauguration. But maybe led by a different composite of companies for the most part. And then mid caps moving back up here, which is good to see. Small caps just breaking out, guys. This is the name of the game. Measured move on this would take you up to 2,000. So we're not even started on small caps, which is exciting because we've been table pounders for a long time. It's nice to see that playing out. More seasonality. Oh, let's see what the AAII sentiment was. By the way, before we do that, let's see. AA sentiment results. By the way, I'm going to be on CNA Asia tonight at 6:15 p.m. If anyone wants to tune in, you can get it on their website. That is like the BBC of Singapore, goes throughout Asia, tons and tons of viewers. Okay, so the bullishness came down a little bit this week. Bearishness went up a hair, so that's good. Emerging markets, again, moved up, pulled back to this support line. We'll work back higher, certainly after the inauguration. Same thing with the Hang Seng, which is basically China tech. we had that huge shoot up in September, October, which was unbelievable. And now we pull back down to this. This is where everyone's getting antsy, which is great. Get all the weak sisters out before we make our next move higher. Very similar to the 2016 to 2017 election to inauguration period. Tokyo can't get out of its own way. 10-year yield bumping up against this downtrend line. This is going to roll back over. Same thing with is there US dollar? It's in this sideways trend up against upper support. This will roll back up. Those are the big two surprises of next year. Canadian dollar, you all are nervous. Oh, he said it was going to go up. When's it going to go? It's going to go up. I'd be long the Canadian dollar here for sure. Oil, no view, but it looks like it's your risk reward is to the upside. Gold rolled over. Remember here, I was like, nope. Everyone would say buy more. Anyway, copper, this is going to turn up with China's recovery next year. So that would be another thing I'd be buying. Probably a good pair trade is short gold, long copper, but I wouldn't short gold. All right, NVIDIA is kind of just hanging out here. I think it's negative today. What else? Google got hit today pretty hard, down 5%. PayPal, rocking and rolling. We don't even talk about it, up 30% in the last few weeks. Actually, no, it's up a lot more than 30%. 30% is because that's when I talked about it on Varney in late August, and I was telling it's up 30% since then. But before then, and I remember these podcasts in the 50s, you literally could not give PayPal away. And it's funny, I'm going to speak at the Money Show in Sarasota on January 7th. And then I fly out to Orange County. And that was one of my 3 ideas last year, and it did nothing. And now it's just going all at once. And it's just the first stop among many. Alex Chris is doing such an incredible job on that. Any other stocks we need to talk about here? So yeah, the utilities are rolling over. They're not cheap enough for me yet to get back involved, but some of these are getting very, very interesting. CCI is great. New money that came in, we put to work in CCI. Existing money, you own it lower. And this is going to work dramatically higher next year as rates compress. Some of the staples are starting to look interesting, but not cheap enough for me. The weight loss drug stocks are getting hit because of RFK. That'll probably be temporary, but they're too expensive for me based on the valuations. I think I think it was in August, we were on Yahoo, and they made me do that segment on like one to buy, one to not buy or whatever. And I said, and Lilly is too high. And they're like, no, but they're just getting started with the weight loss, just like you hear in the NVIDIA story. And sure enough, here we are from August to now. It's from 972 down to 718. It's a pretty big drop, ladies and gentlemen. Suncor. Some of these energy stocks are kind of interesting, but we've got enough with Comstock. All right, so that's Slumer. Let's go through some of the news real quick. Then the article of the week is pretty exciting. I'm even more excited to talk about Advanced Auto Parts than I am Alibaba, because Alibaba is just a waiting game. That's a foregone conclusion. Advanced was looking a little sketchy there. It's gonna be a great story. And by the way, the reason I brought up the guy in New York. So I asked him, because do you do any business with Advanced Auto Parts? And he says 88% of our business. And I was like, why do you do 88% of your business with Advanced? Because I just saw on the same road, you got AutoZone, you have Napa, you have all these guys. He's like, number one, the people that they have at their desk actually understand cars. They didn't come from working at Walmart. Number two, they're fair prices and they get me the products quickly. So that was really comforting to see, because this guy, like, I saw 5 people walk in that say, like, I need new tires, I need this. And he's like, okay, I can schedule you 4 weeks out. I mean, this guy is so busy, you couldn't believe it. And the fact that with that mindset, he's trusting all of his business with Advanced Auto Parts was very comforting. It's an anecdote, but it's better than him saying, no, we haven't used them in 2 years. They're terrible scumbags, you know? I mean, he would have told me that too if that was the case. And it clearly wasn't. We'll cover Alibaba later. I mean, expanding user base, accelerated cloud growth, we know that. Chinese stocks rebound on guidelines to boost shareholder value. More stimulus that no one cares about until they do after the inauguration. Chinese banks surge as CSRC guideline urging more shareholder returns lifts confidence. Citi moves their target price or price target, 12-month price target on Alibaba to $132. Okay, here is the Kelly Blue Book report, which we covered actually, incentives going up. This is the name of the game for volumes. This is the number one leading indicator to volumes is incentives. The higher incentives go, the more volumes you see. Auto credit availability increases across the board in October. Disney gives investors years to cheer about. We agree. Again, no one wanted it in the 80s. Everyone now wants it. Well, no, still people don't want it, which is exciting. Ant Group's quarterly profit nearly triples. Okay, we own a third of this company through our holding in Alibaba. You have zero credit implied in the stock. This will probably IPO in 2025, and we're going to get a huge windfall from that as Alibaba shareholders, but no one's talking about it. Alibaba's quarterly profit surges 58% on strong cloud, offshore e-commerce growth. They also had some benefit of mark-to-market on some of the investments. If you remember last year, they had a mark-to-market markdown. Alibaba's sluggish growth in China commerce drags down results. So here's the negativity, even though they grew. So we'll actually get to the facts. It's mind-boggling how that one author at Barron's, which she seems to have gone on a long extended vacation because the new writer is much better on China, and then Bloomberg just consistently negative. It's amazing. I wonder how euphoric they will be when Baba's over $200 and all the China stocks are humming. They'll probably be the biggest cheerleaders at that point, but time will tell. Baba buys back 414 million ordinary shares, $4.1 billion of buybacks in the quarter, record. Disney's turning record parks profits even before the big expansions. U.S. retail sales increase on autos. Alibaba's, okay, that's the same negative article from China, from Bloomberg. Disney paints a rosy picture for coming years. Building products distributor QXO makes bid for Beacon Roofing. So this was exciting to see. We've covered QXO several times on this. We own it at $12. Looks like $12.70. We made an exception for buying a SPAC above cash value because of Brad Jacobs, so we're up on that one. Look, I think they're paying up for Beacon Roofing, but he needs a platform. And if they get it done, he needs a platform. And once he gets one, I think there's going to be an enormous amounts of opportunities and synergies and the technology that he applies to make it more efficient. And he'll work his United Rentals playbook, his QXO playbook, his Waste Connections playbook one more time, and that'll be a monster run for the next 7 to 8 years. Walmart's earnings, holiday shopping is off to a strong start, which is great. Boeing to lay off 2,200 workers. The headline used to be before Christmas. Look, they did it to themselves. I mean, at the end of the day, bad time to go on strike when you're company. So they'll probably lay off another 5,000 or 7,000, and half of those will be people who were on the strike asking for more money. So some got more money, some got some got a 30 or 40% raise, some got 100% cut. And that didn't have to happen, but, self-inflicted wound. Joseph Tsai, global supply chain becomes... Okay, we got that. Joe Tsai. PDD drops, so they got hit hard this morning. They're down 10% today. Why? Because their numbers were unsustainable. Baba's numbers still went up, so they fended off the threat from these guys. This is a garbage business, in my opinion, and there you go. Alibaba issues, I think they did $5 billion in bonds to fund more buybacks, which is exciting to see. NVIDIA, what was the thing here? The guidance seems to show lower growth, but this may be NVIDIA being conservative, short term, blah, blah, blah. Launch of Blackwell, supply constraints on Wednesday, critical questions about Blackwell's production ramp, and consumer concentration, little room for execution, missteps, blah, blah, blah. The big thing here is that they there was a time when you could buy NVIDIA, and the higher the stock price went, the lower the multiple went, because their margins were expanding and their revenues were expanding and everything was well. Now their revenue growth is capped at $4 billion a quarter, which is still amazing, but their margins have stopped going up, which means they're probably on their way to start going down. So growth is slowing, profitability is slowing, and they're priced as if it's never going to slow, priced for perfection. And so not for us. And could it push higher for a couple of quarters? Yeah, but the law of large numbers is going to kick in, and competition is coming faster than they think. Article of the week. It's all about confidence, stock market, and sentiment results. So this is the most important chart you need to pay attention to. And we've covered it several times before. But you can see here in 2016 that going into the election, the month before and the month of, October and November, after a rally off the rip your face off rally off the bottom lows, where the stock went from, the 60s to $107, just like we just went from 66 to $117, you had 3 consecutive months lower. Month before Trump got elected, month after Trump got elected, month Trump got elected, and month after, October, November, December. Negative, negative, negative. So we've just had October, negative, November, negative, and look, history does not repeat, it rhymes. So would it be shocking if we started to turn up in December? No. Would it be surprising if we went a little lower before we rip higher and have the parabolic move after the inauguration? Also no. So some people said, oh, could it be different and maybe we'll start rallying in December? My answer is, who cares? I mean, literally, what is the difference if this type of move starts in 1 week or 1 month or 4 months? At the end of the day, as long as this happens, the IRRs on the leverage and the options and the underlying stock will be so amazing and catch up for all the lost time that of this taking longer than expected to play out, that it absolutely doesn't matter. All this did, and we got to send the Christmas card to Xi, is give us more opportunity to reload our options that we were blessed with manna from heaven in September, late September and early October. It was unbelievable. And now we have more than we had before that. Okay, so we have reloaded and then some, and we'll probably reload more in December if history holds and we get 1 more month of weakness before January takes off. So that's the story there. Covered the 2 things during, okay. This week, the 2 earnings results we're going to cover are Advance Auto Parts and Alibaba. The common theme with these 2 are that their respective consumers are at or near the troughs in consumer sentiment, consumer confidence, and at major inflection points. For example, if you believe the U.S. consumer is going to stay at these levels of depression permanently, you should sell your Advance Auto Parts stock, okay? So this is exactly how they looked in all the previous coming out of recessions. And again, we've been in a manufacturing depression, not recession, depression for 2 years, and that's starting to turn the corner. And similarly, if you believe that the Chinese consumer will remain depressed and never recover, you should sell your Alibaba stock. What that would also tell me is that you don't look at data. You don't look at the housing prices starting to recover. You don't look at the retail sales. You don't look at the PMIs. You don't look at the exports. You just look at the Bloomberg headlines and the former Barron's headlines when they had that one person who wrote literally 135 consecutively negative headlines when she was writing about it. So I've made my career in the mean reversion game, and it has served me extremely well over the years. One of my edges is recognizing extremes and betting on recoveries, whether companies, sectors, and countries. We are expressly in the time arbitrage business and attract partners, investors who can weather short-term noise in exchange for long-term bounties. We live to tell the story because we employ little to no leverage. We run a concentrated, high-conviction portfolio in which some theses play out much faster than we anticipated and some take longer, but on balance, we aim to realize fully valued exits within 36 months, coming off despondent, overshot low prices. Advance Auto Parts reported earnings last week. The headlines were, quote, Advance Auto Parts shutters 700 stores to shore up finances. What it should have read is, quote, new management with proven track record of success fixes years of bad decisions by previous management in a shrink to growth strategy while maintaining healthy balance sheet through sale of non-core assets. What is fascinating to me is that despite the negative headlines, even the sell side, who usually run for the hills from turnarounds, were constructive with their outlooks. Morgan Stanley had a base case of $50 price target with an $85 bull case. Bank of America was more pessimistic, well below the 2026 consensus EPS estimates of $3.13 per share and MS estimates of $3.12 per share. So, what I always tell you guys and girls is the most important thing with turnaround situation is taking solvency risk off the table. That's why the refinancing of Cooper Standard was the critical catalyst. That's why the sale of Supreme for VF Corp was the critical catalyst. And with Advanced Auto Parts, the sale of Westpac was critical. So all of them have basically taken solvency risk off the table. Now it's just a timing game for them to turn things around and get doubles and triples across the board and more in some cases. So what they're saying here is there's an opportunity to fill a massive productivity gap. You know, operating margins, they're targeting 7% versus the peers at 16%. So even though they're only targeting 7%, when I show you what that means in terms of operating income, it's going to blow your mind, and what the stock trades at when it hits levels of operating income of those levels. Now, closure stores resulting in $2 of EPS at the midpoint. Looking out to 2027, 7% operating margin is being targeted by extracting up to 500 basis points in merchandise efficiencies and SG&A productivity, which would result in $7 in earnings per share in our estimates. Okay, they are not pricing this. Morgan Stanley is not pricing this for $7 of estimates. They are pricing this for $3 of estimates. At $7, this thing could be a $140 stock. It's now trading at $37, okay? Change undertaken. Okay, so that's the story there. Bank of America, a little more pessimistic, but they still come out to $3 by 2026. So if solvency risk is off the table and you can buy it at these levels and revenues are static, let's assume no growth. Here we go. Okay, risk to the upside. Faster than anticipated comp and earnings recovery from restructuring initiatives. Significant improvements in supply chain management, closing the gap between Advanced Auto Parts and strongest peers, and a strategic combination with one of the larger peers. They could get bought out. That would be the worst case scenario for us, because then we're going to get taken out at $60 or $70 when this thing could be $100 plus if we just waited another year or two after that. And material cash generation from planned asset sales, enabling share repurchases and debt payback above our forecast. Management was more sanguine than the sell-side analysts and laid out a clear path to recovery over the next 2 years. So they're reducing 500 stores, which is 10%. They've got about 5,000, and then 200 of the independently owned franchises, which don't make much of a difference. 7% in operating margin by 2027. 2.5 times debt to leverage ratio, and over 500 basis points in operating margin expansion through what we covered. So the most important thing here, because you can read most of this on your own, and I circled all the important points, is this. Looking out to 2027 with all the stores closed, and by the way, the one thing that wasn't covered is closing unprofitable spread out stores in the West Coast where they have no synergies, and actually funding, they're going to open, I think, 30 new stores this year in areas where they have concentration, and 50 next year. By 2027, 50 to 70 new stores. On $9 billion of revenues, which basically assumes steady state, no growth, which they're going to have growth, but no growth, 7% operating margin. Okay. Yields $630 million of operating income, ladies and gentlemen. The last 4 times that they had operating income in the $600 millions were 2018, where they had $600 million of operating income, 2019, where they had $679 million of operating income, and 2022, where they had $670 million of operating income. In those respective years, when the share count was much higher, 10.5% higher than today, the business earned $5.75, $6.87, $7.70 per share in EPS. The stock reached highs of $186, $182, and $244 in each of those years when they had an operating income of $600 million. And I believe management is being conservative because they're assuming no growth, just taking 500 basis points of margin because they no longer have, 3 stores within 1,000 miles of each other, and then they got to pay for a distribution center that they don't need. Just put them into the areas that they control on the East Coast and put more stores there with less distribution centers. You're going to get more than 500 basis points, but let's just assume that they only meet their conservative levels and earn $7 a share. I mean, we've got a triple on our hands is really what it comes down to. We entered this position with the expectation of a double over 3 years. As we're now seeing CEO Shane O'Kelly execute on the plan he laid out in inception, deleverage the balance sheet with the $1.5 billion sale of Worldpac, close on unprofitable stores 10%, consolidate supply chain. Our expectations have moved up while the sell-side analysts have moved down. It will not be an easy or sure path, but with solvency risk off the table, following the sale of Worldpac and a sensible shrink-to-go strategy, coupled with demand tailwinds, this could be another major turnaround Tom special in coming years. Let me repeat that. This could be another major turnaround Tom special in coming years. Not some easy double like Vernado in 6 months or whatever. I'm talking about major. And I looked at one of the analysts who wrote a very pessimistic report after earnings. He's not listed above. He graduated undergrad in 2022. And his LinkedIn picture looks like a high school yearbook photo. A 23-year-old kid is trying to tell us what proven Shane O'Kelly, who ran a $7 billion HD supply for Home Depot, is doing wrong. Look, I'll bet on Shane every single day of the week. Just look at his background, okay? At HD Supply, before that, CEO of Interline Brands, which was subsequently rebranded as Home Depot Pro. Before that, CEO of PetroChoice, largest distributor of lubricants and lubrication solutions. Biggest client, P. Diddy, just kidding. He was also CEO of A.H. Harris, a specialty construction supply distributor. And 7 years as an infantry officer in the U.S. Army, graduated from both airborne and ranger schools, and served as a rifle platoon leader and company commander. He completed numerous deployments with the 1st Cavalry Division and 325th Airborne. Oh, and by the way, he's got his MBA from Harvard Business School and a bachelor's degree from West Point. So I'll take that over the 23-year-old kid who just wrote his first analyst report, bashing the hell out of the stock any day of the week. This is the natural sentiment of sell-side analysts when you are closer to lows. The same uber pessimists become the final upgraders at the next top several years out when their despondency turns to euphoria if they still have a job at the exact wrong time. So here's the drivers of the plant turnaround. Number one, strong demand drivers. There's no question. 13-year-old average car on the road. They're breaking down. They got to fix the parts. Their big strengths are batteries, which you can't ship through the mail, Amazon, filters, and engine management. It's just non-economics to ship it through the mail. 2, we are getting back to fundamentals of selling auto parts, which focus on a blended box. 3, our execution is supported by experienced leadership and improved liquidity. 4, operational productivity review identified opportunities to improve profitability. And 5, charting to achieve 7% adjusted operating income margin by fiscal year 2027. So they'll have $9 billion of net sales with low single-digit comp sales growth. I think it's going to be more than low single-digit when they're running it right. 7% adjusted operating income margin and 2.5 times leverage ratio. So you can see here the number of light-duty vehicles in operation. So these are the macro stories. Bigger market than ever before. Average light vehicles, average age of the light-duty vehicles is 13 years. And so on. So what actions have they already taken? They sold Worldpac. They retained the Canada business. They invested in the front line, meaning people that don't come from Walmart, people that actually come from the auto business that can talk to the pros like a pro and understand what they're asking for. Initiated the supply chain consolidation to build out a hub of market hub of stores, invested in price to improve market competitiveness, and established talented leadership. So it's DIY and it's pro. Current Advanced Auto Parts cash position of $2 billion includes Worldpac sale proceeds. So $2 billion on the cash balance sheet. They are not going anywhere. Solvency risk off the table. Here's the details about store operations, merchandising excellence, supply chain. Okay, so they covered that. All right, operational impact. Greater than 75% of revised store footprint located in markets with number 1 and number 2 share. So approximately 60 to 80 million in operating income savings. So they're basically going to invest in those areas where they have concentration and they are already number 1 and number 2 share, which is huge, versus all this stuff out here where they had a handful of stores and were wasting their time sending trucks thousands of miles to work. If you look at the Northeast and down the East Coast, they own this area, and that's where all the money is and all the opportunity is. So it's going to be a big deal and a big change and a very, very smart, exciting move. All right, so it's funny when I'm writing these things, it takes hours and hours, and it probably takes it to relay. So you got to read that if you're going to be serious about it. If you're not going to be serious about it, then you just listen to what I say and you do what you do. But okay, let's go into Alibaba. We covered these charts. This is what it looks like after the election. Goes down for 2 months into January, and then it starts rallying into the inauguration and beyond. 150% rally. And then straight away from the lows in December to the highs when Trump got out, 228%. Baba went from 85 at the inauguration to over 300 by the time he left office. Look, that's not the only factor. I'm not saying that has to happen. History does not repeat, but there is a tendency to rhyme when different conditions are in place, particularly as it relates to emerging markets in China. And you can see that going back to 2001. Okay, so the key things here, just to summarize, is earnings were fine. Taobao and Tmall grew low single digits. The AI growth in our cloud business accelerated from prior quarters, with revenues from public cloud products growing in double digits and AI-related product revenue delivering triple-digit growth. By the way, the AI product revenue, triple-digit growth, not only did that this quarter, has done that for the last 5 quarters, okay? And people are questioning whether it's going to be the greatest business. That's why we mostly got involved. But the actions they're taking on the retail business will actually have that to reaccelerate as well. Purchased $4.1 billion, reduced the share count by 2.1%. Revenue was up 5% year over year. They decreased non-cash share-based compensation, which was our big pet peeve. They finally took action on that. It used to be all the shares they were buying were going back to management, which was a train wreck. Net income was up 63%. Some of that was investment gains. Cash flow was down because they're making investments in the cloud infrastructure and Tmall. So basically what they said is we're not going to just sit back. Number one, we're going to get more and more share in cloud. No one's going to be able to catch us. No one has been able to catch us. But more than that, we are going to stop Temu and PDD dead in their tracks. We are going to crush these little biatches who have come up from out of nowhere. And that's exactly what they did. And that's exactly what you saw today, which is, which is why Pinduoduo got shellacked. Baba said, no mas, we got $80 billion on our balance sheet. We're going to bury you, and you're starting to see that. Gross merchandise volume was double-digit growth year over year. Big purchase frequency, big user growth. The rich customers, the 88 VIP members, they're buying the luxury. That's going to be the whole story as the economy recovers. Increased by 46 million people during the quarter. 46 more million rich people joined their platform that buy, luxury type stuff. Cloud Intelligence, their revenues were up 7%. The AI and cloud related was up triple digits for the 5th consecutive quarter. And you can read about that. It's unbelievable. They absolutely dominate AI. And the other thing that they have, like Ant Financial, which is not getting any credit, is they have equity pieces in every single AI startup in China. They just say, okay, we'll give you some free cloud and AI in exchange for equity. You don't have to give us cash. So, some of these companies are going to be 1,000 baggers, and we're going to own a piece of them because of Alibaba Cloud. But again, no credit for it yet. The international commerce continues to grow 30%, 29%. That's a big deal. That's going to continue to grow. The other small businesses are doing better, getting closer to profitability, in some cases profitability. But if you look down here, Taobao and Tmall, China Commerce Wholesale was up big. They've proactively wound down their direct sales, which has hurt them. Their Taobao and Tmall minus the direct sales was up 2%. AIDC, and by the way, they said 11/11 is Singles Day, absolutely did great, so that'll show up in this quarter. International 35%, wholesale 9%, AIDC 29%, the logistics business 8%, local services 14%, the movie business, which is tiny, was down 1%. And all others were up 9% for total growth of revenues 5%. That's a big deal. So that's that. And the big thing with the cloud is not just that their revenues were up 7%, but that their EBITDA was up 89% for the 3 months and up 115% for the 6 months year to date. So these are the big things. We're optimistic about the government's macro stimulus policies and are confident in their long-term positive economic impact, drive sustainable growth. So look, it's all there. Confidence in the future, how they're taking actions. And, and everyone worrying about the video, all these people from Tencent thinking, oh, we have video and all that stuff. Well, actually, the video selling has gone down. If you look at industry numbers, and it plays well to our advantage at Taobao and Tmall because the brands need to be looking at which platform can truly bring them more sales rather than just simply displaying their products. He's taking a backhanded slap at all these video sellers that think they're doing well, and the data for the industry for the video sellers who think they're going to take share from Baba are going down, not up. So while they're all going down, Baba is holding steady because they've made some investments. Their cloud is going up. Their international is going up. They still got $80 billion of gross cash on their balance sheet. They're buying back stock like it's going out of style. Another $22 billion on the authorization. They're proactively making investments. I mean, what's better? Gaining share through making investments or just having another $10 billion of cash sit on the balance sheet? And I think at this stage right now, they're so far ahead in cloud and AI. Take some of that free cash flow, make the investments, and just absolutely bury and leave all the competition in the dumpster. And that's exactly what they're doing. And that's why I'm comfortable with the cash flow going down for these investments making up, because I'm seeing the return on investments. And that's what we need to see. And Jefferies agrees. They took their price target up to 42%, which implies about a 60% upside. Sentiment here is kind of neutral. And insider buying in Advanced Auto Parts looks like Thomas Siebolt, a director, bought $100,000 of stock directly, wrote the check himself. Dow earnings, top 30 weights, was revised down by 1.4% in the last 60 days. NASDAQ was revised up by 1.6% for 2025. Overall earnings starting to be revised up. Economic data, jobless claims today came in lower than expected, so that's a good sign. And nothing really huge on the economic data front. And now we are going to do the Ask Me Anything questions. So for everyone who loves the Ask Me Anything questions, stick around. For those of you who just like the podcast part, thank you for tuning in. We'll be back next week and make it a great one. So here we go on the Ask Me Anything questions. First one comes from Lachlan Neo. Hey, Tom, more of a philosophical question. How did you gain confidence to purchase Cooper Standard in 2022 after it dropped 98% from its all-time highs? Did you know they were able to refinance, and was that a catalyst for the stock? Thanks. I'd love to know your thought process behind enduring downturns, especially since you're a fund manager. Yeah, I did know. I didn't know that they would be able to do it, but I knew it would be able to get done. I mean, I have a lot of friends in the private credit business, so my general view was they'll get it done on their own, and if they don't, I'll make introductions for them, and they'll eventually get it done. And they did get it done. Goldman completely raped them, but got it done and took the solvency risk off the table, and that was a key catalyst. So I love that. Moving on, Richard Liu. Like your Etsy idea, but the confusing part for me is their share compensation. A lot of their free cash flows due to employee share. No, that's not true. Let me walk you through it really simple. So he loves Etsy. He's worried that they're giving the employee shares. They all do the same thing, and the CEO hires the board hires some outside consulting agent to pay them to say that it's okay to give our employees all this stock. And that's what happens. And it's just the way it works. But if you look at the numbers, it's not egregious. So they've got $214 million in stock compensation, but they repurchased $464 million of stock. So they're giving away far less than they're buying in, and they're still generating cash. Their operating income was $437 million last quarter. So that's not a reason to like or not like it. That's just the way it is. And not egregious by normal standards. Joseph Baxter, can you take a look at Pfizer? I think it's okay. We haven't made it a position. We covered it many times in the last few weeks. Martin Yang, how do you feel about Canada Goose? We own it. We're fine with it. We haven't added to it, but I think we'll do some work on it this week and maybe add a lot more at these levels. But we haven't made that determination yet. This is just the reason we haven't added a lot is because a lot of it's going to be the emerging markets recovery. They're huge in China and in Asia. So as that recovers next year, they'll recover. But we already have so much exposure through BABA. It's like making two big positions makes no sense. So I think we're comfortable with our positioning in, but we have nibbled down at these levels as new money came in, but maybe we'll do a little more. But we don't want to get too overexposed because we got super amounts of great exposure with BABA. And they're going to trade similarly. So leave it at that. Dievis Lung, thanks for providing great content as usual. You're welcome. I shared your insights with my connections, but they all seem too focused on hype stocks. I know you were starting to look at solar stocks from your past couple podcasts. What's your opinion on Enphase? I covered Enphase. Still not interested in doing anything. I think they'll work as trades. I don't want to own them as businesses. But yeah, I mean, ENPH. I keep looking at them, and most of them keep losing money. But I know they're going to work as trades, so I keep looking at them. And I'm just not going to do anything with them yet. So I'll leave it at that. I am more than comfortable with an error on omission on solar stocks. They are crappy businesses. They're super cyclical and dependent on so many things outside of their control. So if you want to gamble on a trade, you're probably going to win. Okay? So all these are going to go up, and I'm going to get the podcast questions next year like, oh, remember when I asked you about Enphase in November? Well, now that it's up 75%, do you think I should keep holding it even though you didn't want me to buy it? This is the type of nonsense I have to deal with. But the answer is congratulations on getting lucky and get out while you can. That's really the theme when solar stocks go up. So I'm just not there yet. I think there will be some, like I would feel comfortable buying First Solar, but First Solar is not really a bargain. So all the other are low quality garbage. that are going to work great as trades, and we're probably not going to be involved because that's not what we do. Speaking of which, Alex Chris sent me an email, all because we have a merchant account with him. Early results from latest PayPal experience show an incremental 3 to 7% lift. Fastlane by PayPal, our accelerated guest checkout, drives an average 67% conversion for shoppers with Fastlane profiles. PayPal Pay Later increases AOV by up to 55%, giving shoppers flexibility to pay over time. And Pay with Venmo lets 92 million active consumers who love Venmo pay with their balance. So just more excitement from the inside track, but it's public information because he sent it out to millions of vendors. So there you go. How much value would you place on insider buys as a signal? I see a lot of Advanced Auto Parts directors have been buying stock. Is it mostly noise or insightful? Not much weight. I pay attention to buys are way more useful than sells. People sell for a million reasons. They buy for only one, and that is they think the stock's going to go up. As far as Cooper Standard, I've talked to management about buying stock. The problem is they bought a ton in the 30s, I believe, and got smoked. So when it was down from 146 to 33, they thought everything was going to be great, except for the fact COVID came. So they're all upside down, millions of dollars. But they got tons of stock, so they're partners because they bought tons of stock, even though they bought it at much higher prices than we did. So they've got incentive to get it back up into the 30s and well beyond, and I know they will. So yeah, it's helpful, but it's not critical. Landon, and the smaller the company gets, the dumber a lot of the managers are. So, and I'm not referring at all to Cooper Standard. I don't think they could execute any better than they have in the current conditions. But I'm talking about generally, you see a lot of crappy stocks with insiders buying stock, and there's no reason for them to buy because they're absolute dog garbage stocks. And they're wrong. They just buy their own hype. So, short answer is insider buys matter. They're a low weight in our analysis, but insider sells don't matter that much at all. Insider buys are helpful to pay attention to because they got to hold the stock for at least 6 months. I've been looking at Nestle. Have you done any work on the stock or have a view? I think we looked at this a few weeks ago and said not yet. I'd probably be more interested in Hershey. But Hershey's not at a level. I think Nestle is a not yet. See if it comes down a lot more. Yeah, cash flow is reaccelerating. Revenues are going down. Margins have really compressed. Yeah, I just want to see a little continuation of little recovery in revenues. It's probably okay, but if I say looks great and it drops to 70 before it goes to 150. And then you got to say, what's the highest and best use? I mean, it's not really going to be a triple or a double. So what, do they have a big dividend? Is that what you're after? Let's take a look. Actually, it should say here. $3.92%. I think you're close. I think I'd want to see like low 80s to mid 70s before I got more interested to do work. So it's not yet, but it's close. Good eye. Greg Altamari wanted to know your thoughts on Oxy. No. Everyone keeps asking me. We keep covering it every week. It's fine, but Buffett got a much better deal. The reason he bought stock is because he had all these warrants. He did a deal where he lent them money right before COVID in 2019. He got a ton of warrants in the 50s. So everyone's like, he's buying all the stock up here in the 50s. It's probably going to bounce up to 75, 80 over the next 6 months. It's not a good risk reward trade. So pass. Tom Hakings. This one came through for 11. Shoals Technology, another dog shit solar stock. Negative free cash flow. Oh, okay. Never mind. I take that back. Tom. Shoals. SHLS. Maybe this is the solar play that we'll look at. Yeah, it's just they haven't been around long enough for me to be interested. Yeah, this one would be one I'd put in my speculative bucket, but I don't really have a speculative bucket because rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. Let's see. Battery energy, EV charging. Man, I don't know. I just want to avoid this. I have no edge on it. I think it's going to work as a great trade, and I want nothing to do with it. We'll leave it at that. Philippe Andrew Pinkos, thank you very much. You mentioned Estee Lauder. Look, I don't know how to run and make a business, so I don't know what they should do. But I know the turnaround playbook is cut a lot of fat, sell off non-core assets, delever the balance sheet, and find a way to grow. And then in their case, all they really need is a tailwind in China. The reason it's not a huge position, but it is a position, is because it's the same trade as BABA, basically. As the Chinese consumer comes back, this is going to be a double or triple, and it's a high quality business. And yes, there's competition. Yes, I know about Elf, and I know about Sephora, and I know about all this nonsense. But this thing's been around, I think, since the 1800s, and they'll figure it out. So to answer your question, there's nothing I would tell management about what they should do that a normal turnaround playbook doesn't do, and anyone of a quality management experience knows how to do. So they'll do it, or they'll replace this CEO too. But at some point, the business gets so cheap that that it gets fixed, and there's enough here to fix it. Estee Lauder's not going anywhere, and it's a good quality compounder over time. What do you think of GenMab? GMAB. Margins have collapsed. No. What the hell? No, they haven't. All right, what does this do? Develops antibiotic therapeutics for cancer. So they cure cancer. I have no idea if they cure cancer, and I have no edge as to whether they cure cancer or not. So if you're a doctor, maybe you have something to say about it. But for me, we own a basket of biotech, XBI. Those are going to do great in 2025. And we don't pick individual biotech or drug stocks. We people who get it right are often, flipping a coin, and when they get it right, they think they're smart. And the ones who don't get it right go out of business, and you never hear from them. Kava. I like kava. I actually eat kava when I'm in the city. And some people have been asking, can it be the next Chipotle, blah, blah, blah. I don't know. I mean, I think it could, but I don't know if it's as universal of a taste as... The only reason I got interested is because they put steak on it now. Before it was like vegetarian nonsense, and I could have zero interest in that. So the question here is, what are we paying for it? I think the discretionary is going to come back next year. Like all the restaurants that are in the toilet. I know we've talked about Portillo's. My daughter Mimi loves the Portillo's hot dogs, and someone asked about that. That's probably already started to go. Portillo, PTLO. No, I gotta take a look at Portillo's, and I gotta take a look at Kava. My guess is Kava is dramatically overpriced, but let me just check on that before I draw any conclusions. 14 times current sales, 9 times next. Yeah, I just don't pay up for stuff. It's just not in my DNA. So, how about the debt? Wow, this is small business Kava too. I mean, it's packed where I go on. I'm on 40th, and they've got one on 40th and Madison. I'm like 40th and 5th, between 5th and 6th. All right, so here's the issue I have with something like that. You've got an enterprise value of $16.5 billion on $900 million of sales and $100 million of EBITDA. So I'm paying and $53 million in net income. So 20 times 16, 300 something times earnings. I mean, it's crazy town. So let them get smashed more, and then I'll take another look at it. I mean, I get it, but yeah, so what's Chipotle worth? CMG. I don't think they're not going to become the next Chipotle. It's too niche-y. I mean, Chipotle has burritos and steak and meat and all this stuff. This is a salad game, and there have been tons of salad businesses that got out of business. Chopped went out of business. It's not enough. So, and people like Greek food, but like once in a while, like Chipotle, you can eat every day. This stuff, it's like, oh, I want to be healthy. I'll eat this salad stuff. And because they put steak on it, I'll actually go. If they were going to put that falafel crap, not interested. So Chipotle, on the other hand, so Chipotle is an $80 billion business with $10 billion of sales, earning $1 billion. So they're 81 times net income. They're actually doing it. It's, again, it's not my wheelhouse. I think Kava is going to be a good business. Question is, price is what you pay, value is what you're going to get. And I'm not willing to pay that much for that earnings power. I can pay a lot less and get guaranteed earnings power that I don't have to speculate on whether it's going to be a good salad business or a bad salad business. I know that cars break and people replace them. That's why I like those businesses. So I like the idea. I just don't like the price, even though it'll probably work as a trade. Star Surgical from Paul Falcone. This one's probably going to be a good one. He usually sends in good stuff. STAA. All right, so it was $163 stock. It's now a $30 stock. Why is that? Implantable lenses for eye, lenses to the eye, treat visual disorders. All right, so it's like medical devices, healthcare supplies, which we have with Baxter and we're perfectly happy with. But let's see. STAA. All right, so they went negative, cash flow negative, and now they're recovering. Margins are up. Yeah, so Paul's a guy who's been with me on this podcast for like 4 or 5 years, and now he gets it. I mean, he picks good businesses at reasonable prices for the most part, and this one's probably another one. But again, you have to do a ton of work from here just to look at the numbers and say this looks worth pursuing is one thing. Doing the work is hours and hours. I mean, just writing up the article about Baba and Advanced Auto Parts is 10 hours, and that's probably 5% of the work you need to do to commit capital if you're doing a good job. How's the balance sheet here? Wow, this is a small business. So $1.1 billion. Is this trading at 30 times EBITDA? Yeah. 40 times earnings. Yeah, I would have to get comfort in the products and in the growth trajectory to be willing to pay up that multiple. But on balance, it looks interesting. That's all I can say about that. It's a very high multiple for what it's producing right now, but there must be a story that this growth is going to extrapolate forward. So that's what you really have to understand is the defensible moat and the growth ratio. And if you can get comfort around those two things, it's probably a decent time to start a position. But again, a lot more work to do on that one. Nice work. Moving along. Drew Robinson. Uranium, no. Nuclear is going to happen. I wouldn't play just the commodities. It'll probably work as a trade. You want to find some businesses that are going to benefit, and it's too early. One of the ones that we had a multi-bagger on was Rolls-Royce on engine servicing, but they have the small nuclear SMRs, the small nuclear reactors, but they're not going to convert until 2030 plus. So it's early. Let there be a mania rally on that stuff. When it crashes in 2 years, that's when we'll buy stuff for the final phase. For now, it's not the time. Jacob. Yeah, still like Comstock. Jacob. Bob Johnson. Orla Mining. We don't do miners. I'll take a quick look, but the answer is going to be no. I mean, they just have an uncanny way of losing money, regardless of the underlying commodity price. Yeah, I mean, it's cheap for now. But that can change it can change in 1 quarter. I mean, everyone was super excited about Cliff's Natural Resources, and it's just been, not for me. I think your financial analysis is correct, Bob. I just don't want to be in that business. Max Moore, mRNA. No interest in that. I know it's cheap. I know it'll probably work. I have no edge. And I've covered that a gazillion times. How do you exit a position once it reaches your intrinsic value? Do you sell 20, 30%? It depends. I usually don't put it all on at once, and I usually don't take it all off at once. Some I'll take off a bit before intrinsic value. Maybe if something's up 4 or 5x, I'll take off 20, 25%, even if I think it's going to go to 10x. And then, I'll probably take off 50% when it hits my target. And then I usually keep 10 to 20% of a flyer on, because just as things overshoot on the downside, they have a tendency to overshoot on the upside. But it varies by things. And sometimes, you'll have those parabolic moves where you just have to take it all off at once and benefit from that way. So no, that's just experience. You got to learn it by doing it. Quack, common. I think solar stocks are interesting. What do you think of Enphase? I already answered that. And that's it. We're done. We'll see you next week. Same time, same place. If I don't talk to you before Thanksgiving, I will. But whether you're here or not, happy Thanksgiving to you and your family. And in the meantime, make it a great one. Bye for now.